You want to get 60 votes for this bipartisan infrastructure deal. How much can you really tamper with it in order to make sure you get those votes through? But that's really what the rest of the week is going to be about.
John, this includes the Hordern 8-lane expressway out Long Island way.
Named after Anne
It's
Marie.
in the budget.
Is that right?
Yeah.
A road that you'll never go on, Tom.
Yeah,
I'm sure. Anne Marie Hordern, Bloomberg Washington correspondent down in Washington, D.C. It was a bizarre moment yesterday, Lisa, to see the president basically question a ruling from his own CDC. That was kind of strange.
It was strange on every level, which raised, I mean, to me, what is he trying to do? Why did he wait so long when they knew that this deadline was coming up? And why did he craft this CDC guidance, or at least the CDC craft this guidance specifically targeted towards southern states that have been behind? He chastised Republican governors yesterday as well for banning mask mandates. I mean, this is a very complicated message, John. It's hard to get my head around exactly what he's going for.
Tom, a decision from a president and then he's just overseeing it and questioning the constitutionality. Second time lucky there. Tom, of that decision.
You nailed that, John. It's very good.
I practiced, Tom.
The president before. We saw this from the president before, and it's sort of the ad hoc nature that we're in. The idea of policy structure or institutional structure within our modern American politics, John, it's just not there, whether it's Trump Republican or Biden Democrat.
We'll build on this through the hour, Tom. Let's get to this equity market. Into Wednesday, a record highs on the S&P 500. Futures just a bit softer, down 3, negative 0.07%. Outside of that, into the bond market, yields not doing much, 117.54. This day gets interesting as this day grows older, though. A little bit later this morning, 8:15 Eastern, the ADP report, the appetizer for the main thing, the main event. The main event is on Friday, your payrolls report. And then in between, Tom, jobless claims and Vice Chair Rich Clarida. He's talking at 10 Eastern, one not to miss.
Yeah, I think it's going to be fascinating with Adam Posen at the Peterson Institute.
Does he keep Jackson Hole alive, Lisa Bramwich? Does he keep it alive after Governor Brain had come out and poured freezing cold water on it on Friday?
Other than people wanting to take a vacation in Jackson Hole, what's his incentive to do that?
There we go. Lisa, are you saying someone wants to take a vacation in Jackson Hole?
Just take a vacation, full stop.
Coming up, Marvin Barth of Barclays, the head of FX and EM macro strategy. From New York, this is Bloomberg.
Friday is Jobs Day.
For every positive thing you point to, there's something less positive.
The June report fell short of estimates.
The unemployment rate goes up to 5.9%. It's one of those things where you say it's good news. The unemployment rate goes up.
What should we expect to see from July's report?
A lot of reshuffling. We'll continue to see hiring at large pace.
Are people looking to return to the workforce?
Businesses have a lot of jobs to fill. They can't find workers.
The July jobs report, Friday on Bloomberg Television and Radio.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Live from New York City for our audience worldwide. Good Wednesday morning to you. Here's the Wednesday morning price action. Your equity market slightly negative, down to a negative 0.05% on the S&P, on a Nasdaq positive 0.08%, on a Russell. We're advancing on the Nasdaq and declining on the Russell. The Russell down by about 0.14%. Barclays out with a note. My producer Jamie pinging that over in the last couple of minutes, saying the wall of worry, we will keep climbing it. They're looking at Europe for a little bit more of that. We'll talk about that a little bit later. Switch up the board and get to the bond market. I'll talk about this a little bit later, a little bit more too. The note from Citi and a team led by Robert Buckland looking for that move to 2% on 10s. Right now, 117.71. Lisa mentioned the big short squeeze going through this market. We can talk a little bit about that later too. One fund in particular facing a bit of pain off the back of that story. 117.54 on 10s, your 30, 185.29. For me, based on what has not been talked about enough, relative to how important it is, China. Switch out the board and finish on this. Dollar China. Dollar China, the average year to date, 647. Right now, 646. 646.14 on dollar China. That is immense stability on that currency pair, even with what's developing in that country right now. Tom, at least 46 cities, according to our team here at Bloomberg, facing a travel advisory. I think that's really important. The latest news out of Beijing this morning that they're going to restrict travel on that subway over in China, over in Beijing, Tom. So worth keeping an eye on, even with the stability in the Chinese currency.
And some of the caution out there, as John mentioned yesterday, folks, Swiss franc showing some strength, Euro Swissy in well under a 108. It happens every summer, and what it is not baseball. It's a research report that ruins your week. You say not only do you have to read it, but you got to get out the Dixon-Ticonderoga #2 and go over every single ISLM chart in it and its dynamics. The owner of this summer's research report is Marvin Barth of Barclays, and it's something Jeff Staley must read. He's head of FX and EM macro strategy, and I'll tell you, Marvin, awaiting supplies to Mars is an absolute tour de force. Let me cut to the single sentence. We are going to have a self-limiting recovery. Explain.
Yeah, so I think this is one of the things I think a lot of people are missing in a lot of these inflation shocks is that it's not just about the higher prices. If you look, what we've seen is a persistent sequence of downside surprises to output. Not weak output, just downside surprises. And this is very consistent with the global short-run aggregate supply curve shifting backwards. And what that means is that we are still having a very strong recovery.
Right.
It's just being limited by supply.
Here's the money question, and good morning to Michael Ferroli over at J.P. Morgan. Marvin, that's a small bank in America. The idea, thank you, the idea of potential GDP, do we get a permanent shift in it to a lower potential GDP because of this pandemic?
Yeah, see, I think that is still a far more open question. Obviously, bond markets have been gripping with that. I think one of the coincidence here, and it does suggest that these moves to record lows in long-run real interest rates in the U.S. should be questioned here, is that if you think about supply restraining demand right now, that's actually a really positive signal for the future, right? It means you're much less likely to have a boom-bust cycle. You're much more likely to have a slower developing, longer, more sustained expansion. And that's actually likely to support medium-term real interest rate. So, your 5-year, 5-year forward real interest rate, or even 5-year real interest rate, really look pretty stretched to the downside at this point.
So, Marvin, this is a little bit confusing. So please elaborate a little bit more. This idea that if you have a self-limiting recovery where you have constraints, that it's not stagflationary, it's actually positive because it doesn't allow runaway growth to get out of hand. Is that correct? Is that what you're saying?
Yeah, exactly. Now, you could still describe that as sort of stagflationary if you wanted to. I mean, you're getting a combination of slower growth than you expected. That's the key phrase there, than you expected, with higher inflation than you expected. And that's likely to maintain for a while until we rebuild capital structures to accommodate different sources of demand. But that does mean that instead of getting this big, huge surge of demand and then potentially building up imbalances that lead to a recession later, we have a slower, more drawn-out expansion. It's still strong. It's kind of like the slow-carb diet, right? You don't get the sugar rush and the headache and crash afterwards. You instead get a nice sustained boost through your day.
But Marvin, if you take a look, perhaps that's the case in the economic standpoint. However, in markets, they've already priced in an incredible rally. They've already priced in an incredible recovery. If you don't think that that's a sugar high, I'm not sure what is. I mean, how sustainable is that given the outlook that you're talking about?
So what specifically are you referring to in terms of market pricing? Because if I look at real yield, they're pricing not a particularly positive outlook in the world. If you look at a lot of risk premium out there, those are also, starting to show some signs of concern that actually we're not going to have a sustained expansion, or that there are significant growth worries out there. The one market you can point to is equities, and say, wow, that's really pricing in a lot of upside. But when you look at it in equity risk premium terms, it's actually not that exuberant. And take a look at earnings coming in and earnings forecasts. They just keep going up. If anything, they're telling us actually there's more upside.
Take me to the FX market, Marvin. Absolute snooze on some of these currency pairs. Get me excited. What are you looking for? What are your calls?
Unfortunately, Jonathan, I'm not sure that we can get really excited here. I think that's one of the key points about these supply restraints, is that one of the things that is going to do is it's going to limit the ability of the countries that were galloping ahead of everybody else, like the U.S., like some of the commodity currencies, to pull away as much as they had been from some of the softer economies out there, like Europe. And what that means is that it is going to constrain the ability of the currencies themselves to price in that divergence as much. This is likely to continue until we actually do start to see real action from central banks. And I think that's one of the reasons why people are going to be so focused on Rich Clarita's comments today.
Marvin, do you think September could be that moment for that divergence that we can start to push through, say, euro-dollar? We had the Latvian central bank governor out this morning saying September was not the time to talk about their emergency purchase program, so-called PEP. At the same time, we've got Fed officials saying September is the time to have that conversation. Is that the start of this?
Well, it's certainly on the agenda. You clearly have divergences within the Fed. There are some who would like to take a more patient approach. They've been looking back at inflation misses persistently over the last 2 decades to the downside. They're concerned that we're going to see that again, that the supply constraints we were talking about are really all that's behind us. And once you get through that, you'll go back to that low inflation environment. So they really want to give the economy as much stimulus as possible. You've got others who are more convinced that indeed these supply constraints are actually driving expectations and are going to permanently shift out the Phillips curve, and that you should start removing some of that accommodation earlier. This is likely to happen in the fourth quarter of this year, no matter what. But whether it happens at the September meeting, I think is still open.
Marvin, to FX on all this, in your tour de force research piece, John Maynard Keynes and John Hicks were in a milieu where there was fixed exchange rates. We are a floating FX world. Where's the float that we need to pay attention to if supplies don't come in from Mars?
Yeah, so I think this really gets back to that point about how this restraint on growth starts to affect economies, not only in the short run in terms of constraining that divergence I talked about, but also applying pressure to those economies that had more unsustainable policies. And I think one of the things that is a real concern here is in the emerging market space. Yep. Right now, people are focused on the higher carrier you're able to achieve in these, but as long as these growth concerns continue to mount because supply is being restrained, that's going to put more pressure on a lot of those EM debtors. At the same time that it's also forcing them to hike rates that are going to slow their own economies more than anticipated. And that's going to just effectively put them in a catch-22 with their own debt situations. That's a problem that's probably going to manifest in the first half of next year, but it could start to creep in the second half of this year.
Marvin, good to catch up. Good to hear from you, sir. Really good to hear from you. Barclays
Pleasure.
head of FX and EM macro strategy. And Tom, that's always the ultimate dilemma for EM. Downside risk to growth, upside risk to inflation simultaneously.
Yeah, I brought up Indonesian rupiah with their huge problems with the pandemic. Maybe right now worst in the world. Good morning, Brazil. But John, 9,000 to 14,000 over the last 5, 6, 7 years, and that's pretty much in range. And you wonder about a breakout to new Indonesian weakness, new EM weakness, and that's something. There's an opportunity for people that aren't in triple leveraged.
Like you may be.
Yeah.
EM central bankers don't have the luxury of sitting here and offering forward guidance saying we're not going anywhere for 5 years. They don't get to do that. They have to retain some kind of optionality to move in either direction because things move more quickly. And Tom, I think it's interesting that we're hearing a similar message coming from President Bullard of the St. Louis Fed, retaining optionality because this cycle is moving so fast, and with it, more increased volatility is what he expects.
Giving headway off the zero bound as well, just to give him some breathing room, to give him degrees of freedom here another year. That's something, frankly, that Clarida may adjust with Adam Posen today at the Peterson Institute.
10 Eastern, Vice Chair Clarida speaks. Tom Keene alongside Lisa Bravitz. I'm Jonathan Ferro. Equity futures down a single point on the S&P 500. We're negative 0.03%, coming into Wednesday at all-time highs. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Senior Democrats, ranging from President Biden to state legislators, are calling on New York Governor Andrew Cuomo to resign. A report from the state's attorney general outlined claims that he sexually harassed 11 women. Cuomo could face criminal charges. The one-time Democratic star says he never touched anyone inappropriately or made inappropriate sexual advances. A new study says that most children who get the coronavirus recover within a week. Researchers who looked at more than 1,700 British children also found that 1.8% have symptoms that last for 8 weeks or longer. And that suggests that so-called long COVID may be less common in children than in adults. Securities and Exchange Commissioner Gary Gensler is signaling that there is a path for approving a Bitcoin exchange-traded fund. Crypto enthusiasts say that's a move necessary for taking tokens to the mainstream. In a speech, Gensler said that an ETF that complies with the SEC's strict rules from mutual funds could provide investors with the necessary protections. And it's an attempt to phase out the use of the worst man-made contributors to climate change. Bloomberg's learned that BlackRock and other major financial institutions are working on plans to accelerate the closure of coal-fired power plants in Asia. Citigroup and HSBC are amongst the partners. Proposals call for buying coal plants and closing them ahead of current schedules. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
you said was we need to make them in America. Does that include overseas companies making them if they have the plant in America?
I would certainly be in favor of them having operations in America, absolutely. You know, Samsung, TSMC, there are companies that are in allied countries, and you know, we certainly want them operating in America and producing chips in this country, yes.
So we have a significant chip issue, but there are other supply chain issues as well. As I know you're monitoring what's going on. Where have you seen other problems in the supply chains right now in the United States that need to be addressed?
Particularly in home building supplies, you know, lumber and all the related supplies, glue, adhesives, and you see it playing out. You know, home prices are high. If you go to Home Depot or Lowe's, you'll see prices are a little bit high, and that's all because of the lack of supply, just disruption.
Had an exceptional Q2.
It's time.
The narrative of the day is strong earnings.
Bloomberg has the numbers.
We have about $12 trillion worth of market cap right here.
Find out who's winning.
Tesla beating across the board.
And who's losing.
That's actually pretty rare for Amazon. They typically don't miss on that scale.
And the voices to give you the important news.
Samsung reported another stellar quarter of earnings.
We are very clearly looking with confidence about what's next.
Bloomberg Television, your home for earnings season.
For the people here on Earth who are wondering why are we investing all this money in space, this time in space, talk to us about how you believe this will actually help benefit us here on Earth.
We're building infrastructure. This is a road. We're building a road to space so that future generations can build the future. We live on this beautiful planet. It's the most beautiful planet in the solar system by far.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Key to NYC Pass will be a first-in-the-nation approach. It will require vaccination for workers and customers in indoor dining, in indoor fitness facilities, indoor entertainment facilities. This is going to be a requirement. The only way to patronize these establishments indoors will be if you're vaccinated, at least one dose.
New York City Mayor Bill de Blasio there, a shift in this country. We keep repeating it over the last week. From New York City this morning, good morning. Alongside Tom Keene, Elisa Abramowitz, I'm Jonathan Ferro. Here's your equity market. Record high into Wednesday. Equity futures down a single point. We're down by 0.03% on the S&P. Muted price action on euro dollar. That currency pair negative 0.07%. Euro dollar 118.56. Your treasury market basically unchanged, Tom, on 10s. 117.54. Yields going nowhere this morning. Ahead of Vice Chair Claridge's speech.
Yeah, and I'd also note resilient equities. I think after what we saw, and you mentioned the record highs SPX, John, yesterday, I just think to see not the bid, red and green on the screen, but nevertheless, equities really holding up speaks to the equity premium that we're talking about with these new lower yields, a new low yield regime. Right now, and so important is the idea here at Surveillance that we like to look at leaders, experts in their field, and find out how gifted they are. We particularly look at the gifted who long ago and far away adored Manchester United. And John, it is a storied story of Dr. Bhakti Hansadi of Johns Hopkins.
You want to start there? That's where you want to start the conversation.
This is way more important than where we are
let's
right
start
now
right
in
there.
COVID.
Doctor, forgive us. I'm going to bring you in right now, and that's where we're going to start. Dr. Bhakti Hansadi there, Johns Hopkins Associate Professor of Emergency Medicine. Doctor, will you tell Tom Keene your David Beckham story, and then we can move on?
Do I have to tell a David Beckham story? I was a jewelry girl before David Beckham was famous in a city in Manchester, and I served him at a jewelry counter. I like to think he was dating Victoria Beckham and buying a gift, but I can't be sure.
There we go.
There
we
we
happy
go.
with that?
That's news you need to know.
That is.
Can we move to COVID?
Let's move on to the very serious news of this pandemic. Bhakti Hansadi, we got a lot of questions in a 1-hour interview. I don't buy first wave, second wave, third wave. If it's not a third wave, what is it? Just one entire pandemic?
one awful onslaught of a horrible disease. Yeah, like stop calling it waves. Like just call it what it is. It's an ongoing pandemic that we have failed to overcome.
If we see Louisiana and Florida spiking, Indonesia with grim data as well, can you support the giving of money to make the unvaccinated vaccinated? Is that money well spent?
I think so. And so the thing is that we are now a global community. People travel, variants spread. Delta has spread worldwide extremely rapidly. Unless we improve vaccination rates, we will not decrease the number of circulating virus, and thus we will continue to have variants of concern. So we have to vaccinate globally if we are going to overcome this.
All right. So meanwhile, as Tom Keene lobbies for $1,000 for getting vaccinated, there is a question going forward about what is more likely to get people actually to bite the bullet and get the shot. A recent Kaiser survey actually showed that 3 out of every 10 unvaccinated individuals said that they would be more willing to get inoculated if the FDA officially approved the mRNA vaccinations, which could have come as soon as early next month, at least when it comes to Pfizer. What's your sense of how realistic this is, that would actually open up a huge surge in people willing to get vaccinated?
So about getting FDA approved, I think is extremely possible. We have more data for this one vaccine than we have for many of our other studies. And I think we're well on the path to comfort and FDA approval. Will it change people's likelihood of getting vaccines? Not unless we manage the negative media that we see around vaccine complications. Individuals consistently overestimate the likelihood of getting sick post-vaccines. Unless we manage that dialogue, make more transparent use of the data, that how safe the vaccines are, I don't think it'll get people to that comfort level.
Dr. Ansari, the Delta variant has only set that communication back as breakthrough infections start to make the headlines. What do we know about breakthrough infections and how closely, frankly, the federal government is even tracking this to be able to give us an accurate read of how effective the vaccine is at preventing infection?
So it's tracking it extremely closely. We have vaccine data on all patients that are usually admitted to a hospital, and we know what the COVID positive status is, right? So we have the data. Breakthrough cases are known, expected. What is really positive is that even in those breakthrough cases requiring hospitalization, we have not been seeing deaths in vaccinated COVID positive individuals, while we are seeing death in unvaccinated COVID positive individuals. So vaccines are still effective.
Yeah. Bhakti, to a pro like you, what's the percent vaccinated where you sort of say in your head medically all clear? Is it 70%, 80%, 98%? I mean, if you look at typhoid or smallpox, etc., what's the number in your head?
So traditionally, the number that we aim for to get herd immunity is greater than 90%, but that is heavily influenced by human behavior. So vaccines are one part of the puzzle in mitigating transmission. The other is our human behavior, such as masking, such as social distancing, such as avoiding situations where large numbers of individuals, vaccinated and unvaccinated, are mixing together.
Doctor, we've got to leave it there. Good to catch up. You're a good sport. Dr. Bhakti Honsati there, Manchester United fan, and Johns Hopkins Associate Professor of Emergency Medicine. I liked how you did that, Tom. You teed me up to be the person I had to ask that question.
I didn't know this. Like, John, seriously, bend it like Beckham.
Honestly.
You can do that. You can kick the ball, John, with both sides of your feet to do that?
Yeah, we can talk about that later too. Lisa, you wanted to get serious and talk about the pandemic. I wonder how New York City is going to roll out this policy and what it means for people coming from out of state into New York who want to go into some of these restaurants and want to go indoors.
Which starts to raise also the issue of which vaccination is eligible, right? I mean, is it all of them? Is it just Pfizer, Moderna, and the J&J? Or do you start accepting some of the others that are more likely and more prevalent among tourists? Look, I am not sure what this rollout's going to look like, but what it's clear is we're moving closer to mandated vaccinations, and as we head towards school, I'm wondering when we're going to see mandated vaccinations among school-age children.
John, here's the solution.
$1,000.
Even a dummy like me did this.
What Tom is doing right now is holding up the Excelsior Pass.
Yeah, on radio it looks
on
great.
his smartphone. And Tom, very easy to download, very easy to fill in the details, but to have the Excelsior Pass, you need to have had that vaccine here in New York City.
Yeah.
In New York State,
Okay, so
rather.
Pennsylvania
and Tom,
doesn't
if you
pass.
haven't had that vaccine in New York State, then you can't get that pass. And that's the question I've got right now. If you come from out of state and you try and frequent some of these establishments, do you need the Excelsior pass, or is that little cardboard thing with some scribble on it, is that enough?
That is enough. That's what the New York Times said.
That's going to get it done, Lisa.
Yeah, but then you raise the question of forgeries, et cetera. It's just a threshold to try to say to people, if you want freedom, you need to get vaccinated. And I think that that's the clear message. And whether it's foolproof is probably unclear. Really, the reality is it's a messaging
Tom is going to go around the bars in Manhattan the next
out.
couple of weeks and see how this is getting rolled out, just to see how effective it is. Research, Tom.
Expense.
Then you can expense it. Exactly, Lisa. Steve Chevron joining us next.
The Amex says do it.
From Federated, from New York City this morning. Good morning. Futures down 2. Your S&P 500 just a tiny bit softer this Wednesday morning. Good morning. This is Bloomberg.
Is entirely online, ostensibly because of the pandemic, but in large part, we're seeing a massive pivot to mostly live streams for video game coverage. We're going to be all online instead of in the convention center for the first time this year, and that promises to be a really different experience.
Industry has really been interesting during the pandemic. It has actually grown substantially since everyone was stuck inside. And of course, this makes sense, right? We're all looking for some amount of entertainment, and stuff like Fortnite in particular offer also a social component, right? People can join up and kind of meet up online and spend time with their friends. So in a lot of ways, this all makes sense.
What seems to be a really tough situation better than almost anyone else.
We've worked hard on the supply chain. There's no question there's a lot of work to do in the supply chain for semiconductors. And we're happy that we were able to exceed our second quarter guidance, as well as, guide up for the rest of the year.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Once
the market really starts to doubt the potential for reflation, the potential for growth, that can kind of spiral out of control.
There's always pullbacks, and mini corrections, maybe even a correction ahead.
The Fed wants to hike rates. Not now, but they will want to hike rates.
The Fed is flying as the rest of us.
The market's thinking the Fed does nothing. My guess is we don't get a tightening until after the next presidential election.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Coming into Wednesday at all-time highs from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market on the S&P, -3 this morning. Futures down not even 0.1%. Tom Keene, it's onwards to Vice Chair Clarida a little bit later this morning.
A lot of people out saying it's a quiet tape, John. I disagree. The Vice Chairman confronts new lower yields, a bid on bills, notes, and bonds, that negative yielding sum worldwide up and away.
And a payrolls report just around the corner this coming Friday, Tom. In between the ADP today, claims tomorrow, payrolls Friday morning. Does that set us up for a more interesting Jackson Hole meeting month end?
Does it set us up for the disappointment of May 7? I don't go either way, John. I'm just humbled by the last number of months of the payroll report. We'll see what we see. And then, yes, that will affect Jackson Hole.
Working out the path forward, Lisa, you've got to go to China. I really do think you have to start in China right now as the restrictions start to build and the downgrades start to come through.
From Nomura in particular, as people take a look at some of the social restrictions, you take a look at the flight trackers. Booked flights in China have fallen dramatically week over week as people start to hunker down in Beijing now, having issues even with their subway. Again, how much is China an outlier and how much are they a map forward of what we can expect globally in this start, stop recovery from the pandemic?
Very different tolerance levels, Lisa, around this pandemic, and I think that probably matters.
It does matter. I just want to point out a Westpac study overnight that showed that vaccination progress has been the most reliable metric when it comes to predicting G10 FX performance, just highlighting how much this all comes back to that. If you can't get the vaccination rate up, you can't get a recovery.
And John, what's so important here, Dr. Bayer yesterday from Johns Hopkins, he said, look, it's not only vaccination, but it's the efficacy of those mRNA vaccinations that make it happen.
Which is why, going back to Lisa's point, sterling has been the poster child for a lot of this. The effectiveness of rolling out the vaccine more quickly. Sterling really got a bit off the back of that. Tom called me last night. He said, I'll give you $100 per hour if you keep bringing up the Vanguard story just to prove that I was right and let you have a victory lap.
Why
So
didn't
Tom,
you
do you want to go there? Well, Lisa, what he wanted to do was just really reiterate it after you called him out yesterday for saying you said 1,000.
No, she had company.
1,000.
Oh no, she had company.
You said 1,000. Who's going to do $1,000? Vanguard's doing $1,000 if you get vaccinated, Tom Keene.
Well, they are. And, again, is it money well spent? Look at the trillions we've spent on this, and some of it is for terrific aid that was necessary. But every company, and not just big business, mid-business, small business, whatever, and just get them refunded by the government and move on with a 90% vaccination rate.
Hold on,
That's
TK.
a doable goal.
What you just said is interesting. You think the administration should offer a tax credit based on whether you go and get vaccinated or not?
They should offer a dollar-to-dollar savings to business to assist people in getting vaccinated now.
Lisa, final word?
The focus for me is, should we be looking at the carrots or the sticks? At what point do you start mandating things? And I think that is where the focus of gravity right now really is among a lot of businesses and elsewhere.
Sticks and carrots at the moment, it feels. Equity futures down 4. Where's the show going?
We're going
down
down
1% on the S&P. In the bond market, we always are. 116.54 on 10s. Yields come in almost a basis point. Euro dollar down almost
Look at the real yield, John.
Euro dollar 118.54. TK, let's go there. I can freestyle with you. Let's get it up on a Bloomberg terminal right now. 121, negative 121 on reals, and Citi looking for a 70 basis point move on real yields, Tom, the other way. What would that do to this market?
Oh, turn it on its head. Oh, there's no question. It's a bold call, and maybe that's what this time of year is. It's a time for bold calls.
Maybe. Lisa?
Well, looking forward, let's bring this to what we're looking at today, and this really ties into the debate, which is how much dynamism is there to the economic recovery, and it really all hinges with jobs. That's what the Federal Reserve is looking at. That's what a lot of market participants are looking at. The ADP report today, not necessarily the most indicative of Friday's jobs report. However, it's something. We get the expectation for 638,000 new jobs added to private payrolls. That's the whisper number. You can whisper all you want, but the key issue here is how A, predictive is this, and B, how much momentum are we seeing given some of the uncertainty around the Delta variant that has hampered certain areas. Speaking of which, 10 a.m. we get the U.S. ISM Services Index for the month of July. Do we see a slowdown because of the variant that is spreading, because of some of the hesitance that people have to go out, because of some of the additional restrictions, whether mandated or just voluntary, with people concerned about their health? And also at 10 a.m., Fed Vice Chair Rich Clarida delivering a speech at the Peterson Institute. The issue here is how much will he indicate in terms of the importance of the jobs report, in terms of how many jobs reports he needs to see that are strong, John, before he indicates that he wants to see a quicker tapering of the monthly bond purchases. He is such a key member that what he says will move markets.
And we haven't seen a speech from him since May. The goal is this wide for him to say whatever he wants to say today. The speech will be on, Tom, outlooks, outcomes, and prospects for U.S. monetary policy with the Peterson Institute. He has the license there to say whatever he wants to say.
Keyword there's John, prospects. He's got to look forward here. He's got to get out and explain the character and the quality of their new ex-post approach.
Let's bring in Steve Cheveron, Federated Hermes portfolio manager. Steve, we were talking about the bond market. Here's your line. We think that the 10-year is a price in search for narrative. What narrative is it about to find, Steve?
I think it's going to be searching for a little while longer. I think volatility really starts with the federal funds rate and monetary policy. And I think there's just a number of factors right now where even a couple of weeks ago, you may have thought you knew the pace, right? Or you thought you knew how things would play out. You'd get maybe a better than expected jobs number come later this week. You had progress on the virus. You felt like you had some sense on what the path towards tapering might be. And that's really been thrown into disarray, part by the Delta variant, but probably more acutely or more specifically by the response from regulators to what's going on with Delta variant. I think the Fed's hedging its bets. We'll see what the jobs number is this Friday. We believe that what you have to do when you're looking at a period of uncertainty like this is fix your eyes to the horizon. Yeah. And the horizon's 23, and we think it'll be pretty good, and rates will be higher. But I think you're in for some period of chop here.
Steve Cheveron, let's go to the Steve Auth reality, which is you look at the equity risk premium, lower yield, flip the reciprocal, you can withstand higher multiples. Are some of these higher multiple equities, are they the kind of higher multiple equities that lead to be value? I'm just going to keep talking. I figure by the time I'm done talking,
I'm told he's back, Tom. He was just getting a call on Skype.
Thank you for keeping me around there, not just dropping me off, guys.
Well, it was 50-50. We could have gone either way. You flip the reciprocal, Steve Cheveron, and I'm sorry, the growthiness people are worried about looks awful value to me.
Yeah, look, I think you can withstand higher yields in this market. If yields move higher, I think let me say it this way. I think the equity market's actually in pretty good shape either way. In a slow growth environment, you're going to do it on the multiple, but it's going to be more growthy parts of the market. If you get rates moving higher because of better growth and inflation expectations, I think the market can still move higher. It's just going to happen more on the cyclical side. Now, that's the trade we've been playing for, and obviously that's not been what's happened the last couple of months, but we think it still does after this period of chop.
Going forward, Steve, what's the best bet in terms of the most outperformance going forward?
Talking about equity markets or broadly speaking?
Equities.
Yeah, look, I still think in this environment, with the 10 years sitting where it is, that your best risk reward is in value cyclical parts of the equity market. And I'm talking about energy and materials and industrials. We just think that this inflation that we're seeing right now is going to, in fact, last longer and be a little higher than the market anticipates. And in that environment, we think that you will see yields rise over time, even if it's going to take a little while over the next couple of weeks.
Steve, in other words, you're expecting yields to rise and for cyclicals to outperform. How much? Is this going to be simply that you see big tech lose value or just that they lag behind?
Yeah, I think if you look at the period between Labor Day and let's call it April of this year, it's instructive, right? Tech was up think it was up 5 or 6% over that period. I don't remember the exact numbers. But you had value cyclicals that were up, in excess of 30 or 40% in that environment. So I don't think there's some impending doom for growth. And I think they are still very much a long-term winner. But I think you will see value outperform if that's right. Look, even if you look since 2011, which has been in a low rate environment the entire time, outside of the pandemic, you've never had yields this low. So unless you believe that you're going to have high recession risk over the next 12 to 24 months, there should be upward pressure on these yields.
Steve, good to catch up. Apologies for the technical disruption. No idea who was calling you. Steve Cheveron, Federated Hermes Portfolio Manager. You can tell us later. I'm sure, Steve, thank you.
David Beckham.
Higher yields in the bond market. What does it mean for this equity market? This is what Robert Buckland and the team over at Citi had to say. We factor this bearish bond view into our global equity strategy. Amongst regions, we downgrade the tech-heavy US to neutral. We upgrade Japan to overweight. We remain overweight UK equities. It is a big call, Tom, and a call that many people share.
Maybe not the magnitude they share, but yeah, I'll take your point, John, that they're moving in that direction. That's the angst out there. I mean, we bust Lisa's chops, but that's the fear that's out there right now. Yeah. But that's a magnitude call that he's making.
Well, a negative 1.21 on a real yield. Maybe some people believe there's some asymmetric risk here, Tom, that yield surely can't go lower. But how many times have we heard that over the last year?
This is what it's about. You're in the game and you have an opinion and a belief. But on a magnitude basis, this Citibank call is huge.
Yields back to 2% on a nominal 10-year yield, Lisa, and that's the equity portion of the argument.
It is hard to be in macroeconomic hedge fund right now, because if you make a bold call, you can have a bold loss, and that's definitely been something that we can get into with the short call.
You really want to bring that up? I'm going to give you the space to do that in a couple of minutes' time.
I give her the space.
She's going to have the space. Talk about the bond market, a big short squeeze with CT.
She beat me yesterday afternoon. What she did to me in a game of Parcheesi was unspeakable.
How did that go?
I got crushed.
Down 4 on the S&P.
I had 3 pieces left in my little...
Negative 0.1%, record highs. It's a Wednesday from New York. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Researchers say that vaccines targeting the highly transmissible Delta variant may now be needed. The authors of a study looked at recent samples from about 98,000 people in England. They found that vaccines' protection against development of COVID systems was 59%. That's down from 83% earlier. That indicates the antibodies raised by current shots are less effective. In China, the widest coronavirus outbreak since the start of the pandemic is hampering tourism and spending during the peak summer holiday. That has analysts reviewing their economic growth projections. Nomura has lowered GDP forecasts for the third and fourth quarters. The highly infectious Delta variant has spread to almost half of China's 32 provinces. And the CDC has extended a ban on evictions in parts of the U.S. with high transmission of coronavirus. The new ban will be in place till October the 3rd. That move is likely to appease progressive Democrats for now, but President Biden warns that the new ban will face legal challenges and may be found unconstitutional. Private equity firm CVC Capital Partners will invest $3.2 billion in the Spanish soccer league La Liga. It's the home to Lionel Messi and other superstars. The buyout firm will take a roughly 10% stake. The investment comes at a crucial time for the league. Like other soccer leagues in Europe, it's seen its finances hurt badly by the coronavirus pandemic. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
How do you assess the sector as a whole? Is it making a better case for itself at the right price at this point?
Most of the big hedge funds, most of the people that have been growing, have been delivering very good performance. We have, but so is a number of the peers. You know, it is definitely the hedge fund business is getting more about the large getting larger and generating more performance, being able to hire the best people, thereby generating better performance, thereby getting larger. So when you look at the performance of the largest, say, 20 or 50 hedge funds, the performance has been pretty good over a number of years, and the inflows have been pretty good. You know, this is another quarter of positive inflows for us. I think one of the bits you're seeing at the moment is every client is worried about inflation. When they say they're worried about inflation, what they really mean is, I own a load of bonds, is that going to cause me a problem?
I assume you have a lot of people saying the food isn't as healthy as they might want it to be. Is that the biggest challenge, or just growing the company?
Ray Kroc had a famous line, if you're not green and growing, you're red and rotten.
The momentum of a $20+ trillion economy in the U.S., the resilience that has been the result of the Fed rescue program, and probably an overabundance of fiscal stimulus, tells us that we've got a further upside here.
That man is one of the most bullish on the street right now. It's John Stolfus of Oppenheimer, looking for 4,700 on the S&P 500. Record highs coming into Wednesday alongside Tom Keene, Lisa Bramford, I'm Jonathan Ferro. Here's your equity market right now. Futures -4. We're down 1/10% on the S&P. In the bond market, let's sit on it for a little while.
Stunning.
We're down a basis point to 116.21 on a nominal 10-year yield. On a real yield, Tom, -121.
We all have different data screens on the Bloomberg terminal, John. Yours looks different than Lisa's, looks different than mine. But my fixed income section on my screen, I'm sort of saying, really?
Yeah, and it's Europe, it's Asia, it's Japan. And Lisa, the floor is yours. The short squeeze in the bond market, and a victim of that short squeeze too.
Yeah, so there's this hedge fund that came out with a 10% loss in its macro decade. It's called Alphadyne Asset Management. It lost $1.5 billion in this rate squeeze, and it just highlights, look, it makes sense for yields to go higher, for that yield curve to actually steepen. That's what everybody was betting, and it just shows how you can absolutely slammed, John, if you try to bet against the Fed, and if you try to bet against this bond market. And this is one thing that I'm concerned about. How much are the bears getting beaten out of the market, creating a potential fragility that people are underestimating?
Great reporting from the team, Nishan Kumar and Sri Natarajan, revealing that particular fund's pain, and I imagine there's a lot more still to come. CVS, I want to get to CVS just quickly, Tom. Beat and raise. Beat on earnings, raising the outlook, and I deliver the and, Tom, because they've also boosted the minimum wage to $15 per hour effective July 2022. It's what this administration wanted to do, but private companies in this country are making that decision themselves.
It's not $100,000 that you name the Wall Street firm, John, but the answer is it's a bigger deal.
Well, this is the market right now.
Deal.
Does 15 get it done, Tom?
Yeah, no, I don't think Amazon, the new Amazon statistic, I may be out of turn here, but I think it's $17 an hour.
The market doing the administration's work for them seemingly right now, Tom.
There's a news flow today. Futures at -5. Dow futures, John wants to hear -53.
Always
Emily
happy to hear
Wilkins,
that.
thank you. Emily Wilkins joining with Bloomberg Government right now. Emily, it's real simple. At least we knew what we had. President Trump, Dr. Fauci, with basically President Trump making up his COVID policy day to day. Dr. Fauci's still there with President Biden. But what is the structure of the White House response to where we are now with this pandemic? To me, it's a mystery.
You have heard President Biden continue to talk about the Delta variant, continue to highlight the fact that the Delta variant is more transmissible. You've seen the CDC bring back some of that mask guidance. But at the same point, I think throughout this entire process, if there's sort of been this one underlying storyline, it's that there's really only so much that the federal government gets to do. We've really seen a lot of this happen at the state level, at the local level, and you're seeing that continue. And you're actually seeing that now with the White House's approach. Instead of trying to do a national sort of mandate, try and say, okay, well, look, these are the areas where we're having the most problems. Let's just try and focus on these areas where the rates are going up.
Emily, I put out my book for Labor Day today, Greg Grandin's magnificent The End of Myth. I can't say enough about this book, folks, about the fabric of America. And the center tendency of that book is Andrew Jackson and the Jacksonians on. I mean, President Trump had Andrew Jackson's portrait in the Oval Office. I mean, it is President Biden fighting against a massive Jacksonian tendency towards state and local rights. That's what we're talking about.
To a certain extent, yes, he is. He's trying to sort of overcome what you're seeing from some local leaders who have said, hey, we're going to ban any sort of mask mandates. Those aren't going to be allowed. And at this point, it's one of really messaging, which is why you keep seeing Dr. Fauci on these Sunday shows and other White House officials coming out just to talk about the virus and about COVID-19 and the White House's response and what they'd like to see. If you listen to them, a lot of what they do is trying to make the argument for why people should be getting vaccinated, why we need to be wearing masks again. It's really a messaging war at this point that the White House is fighting.
Meanwhile, talk about this for messaging. The CDC taking the lead on the eviction moratorium and suspending it in certain places for health reasons, really targeting sort of certain areas that have been more hard hit by the pandemic, in particular the Delta variant, in particular in the South. Meanwhile, President Biden sort of giving a confusing message about his legal authority to take action. What's the path ahead for a more permanent option, as this obviously will face legal challenge?
So yes, the White House and Congress, what has been discussed behind the scenes the last few days have been, well, what's going to happen with the legal challenge? How is that going to go? Remember, the Supreme Court ruled in a 5-4 ruling that, Congress, the Congress's power kind of lasted until July 31st, and after that, they would need a new congressional reauthorization for this eviction moratorium. Congress can't deliver that at this point. They don't have the votes. But what the White House has essentially done here is bought Democrats a little bit more time, because if this does go through the courts, if this does get challenged as is expected, that's not something that's going to necessarily happen overnight. That's going to give Democrats in Congress some time to figure out what they're doing. It's going to give Speaker Nancy Pelosi time to potentially get people on board, Chuck Schumer to figure out the Senate, as well as just the distribution for the $50-some billion that Congress has allocated towards helping renters stay in their home, as well as making sure that landlords get their payments, taking time to make sure that that money goes out. And once again, we're going to tie that back to the state, to the local. I mean, that's something right now that the federal government is really having to encourage states and localities to do. Say, hey, this money is out there. You guys need to make sure it is getting to the individuals that need it the most.
Emily Wilkins, good to hear from you down in Washington, D.C., our Bloomberg government reporter. Tom Keene, even the best of us have to change our plans. The former president of the United States, I understand, is now going to have a smaller birthday party.
Mike Allen sums it up at Axios this morning, and they've responded, John, to where we are. We're all doing this, John. The former president on Martha's Vineyard goes from a really significant fest, if you will, back to friends and family. And John, frankly, we're all doing this with a bombshell here in New York City that you got to show that vaccine pass to get in a restaurant.
The problem has been, Tom, that we're not all doing this. And often the people making the decisions at the top of government, whether it's the federal government or at the state level, haven't been doing it. And I'm thinking of California over the last 12 months with Governor Newsom.
They have a leg up.
And others too.
Well, and there's also a question about mixed messages from health officials. I mean, just yesterday, the National Institutes of Health Director Francis Collins urged parents to wear masks, even if they'd been vaccinated, at home with their children, if the children could potentially be exposed. And then she backtracked on that after a lot of pushback. I mean, the risk tolerance is individual, and frankly, it really comes down to a personal choice, in addition to also having a broader health message.
John, we don't have time here, but this is math. We are conflating third-order effect with the first-order effect, and the first-order effect is get vaccinated.
Coming up in the next hour on the market, just going to shift gears, Tom. The old shift gears.
Talk about yield. Yield is
RBC
stunning.
Capital Markets joining us on this economy. This bond market, 116.21 on 10s, yields in a basis point. What is it, Tom?
Stunning.
Thank you. This is Bloomberg.
Can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
Friday is Jobs Day.
For every positive thing you point to, there's something less positive.
The June report fell short of estimates.
The unemployment rate goes up to 5.9%. It's one of those things where you say it's good news. The unemployment rate goes up.
What should we expect to see from July's report?
A lot of reshuffling. We'll continue to see hiring at large pace.
Are people looking to return to the workforce?
Businesses have a lot of jobs to fill. They can't find workers.
The July jobs report, Friday on Bloomberg Television and Radio.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Live from New York City for our audience worldwide on TV and radio. Here's the price action this Wednesday morning. Equity futures declined by about 0.1% on the S&P. We're down 5. On a Russell, we're down 1/3%. We're negative 6 or 7 points. Citigroup out with a note of the morning from Robert Buckland of the team, downgrading U.S. equities to neutral. Here's the why. It's the call on the bond market. Switch up the board and get to the bond market. I want to look at the 10-year nominal and real. Your 10-year nominal, your yield right now, 116.21. They're looking for a move from 116.21 into 22 back to 2%. But what's interesting for me, Tom, that's the nominal yield call. Within that, real yields right now, negative 120. They were about 121 just a moment ago. They're looking for a 70 basis point move there, higher. Now, if we get a 70 basis point shakeout on real yields, they're saying for the equity market, it means the following. Get long Japan, get long the UK, get overweight those two, and cut the US to neutral. That's the equity call off the bond market call.
John, can we clarify that? How about Dow 29,000?
I don't know what it means for the Dow, Tom. I think they're looking more to the tech-heavy S&P 500, but
that could be.
You can talk to Robert Buckland. For me, Tom, the additional call, here's the interesting one. It's in foreign exchange. Switch up the board and get to euro dollar. If you're about to see a move back to 2 on 10s on a nominal and a 70 basis point shakeout on reals stateside, I want to understand how the European bond market behaves in a mix. What it looks like. September's a key date for me for a whole range of reasons, but for central banks, it's clear the Fed's going to have a conversation about tapering. For the ECB, the central bank governor from Latvia this morning says he does not want to have one in September. Euro dollar with a bit of a gap lower today. We're weaker. Euro dollar back to 118.61. It's some marginal weakness. We're basically going nowhere. But Tom, I do wonder if you get a 70 basis point real yield move stateside, what it means for this FX market and whether European yields get left behind. As Lisa pointed out a little bit earlier this morning, negative 50 basis points on a 2-year yield in Italy, basically in line with the depot rate.
Yeah, but John, you talked about this 3, 4, 5 days ago, and I just think it basically sets up a growth differential between the U.S. success and, again, a non-fiscal oomph in Europe, and, Tom, that's where you see it.
What have market participants been waiting for? A growth differential and a policy differential. And once you start to get a policy differential, you can push it through this FX market. We just haven't had a big one in a big way just yet. 118.62 on euro dollar. Some things to think about. Let's get you some movers. Here's Romain.
Hey, good morning, John. Let's walk you through some of the biggest volume movers out there. The biggest of them all is Robinhood. Remember, this was a huge debacle last Thursday. The company has the dubious distinction right now of having the worst IPO, at least the worst single-day debut for an IPO on record, at least for a company of its size. That's a thing of a past. Since that debacle on Thursday, the stock has rallied about 30% over the past 3 sessions, Tom, and it's up 14% here in the pre-market.
It is, and what's important here, Romain, is, with Robinhood, you've got to ask the obligatory CFA Level 2 question. I mean, Romain, you've got to dive into the fundamental details of Robinhood if you've passed the Level 2 CFA exam, if you've done that.
If I've done that, well, thank you, Tom, for that segue there.
Congratulations, Mr. Bostic.
Thank you very much. It's a huge milestone for me. It means I'm about 30% closer to being as smart as Taylor Riggs.
Close.
All right. The rest of the movers here, AMD, that's your second biggest mover of the day. This is actually notable, Tom, because that was actually a fundamental story there for AMD. You're talking about a stock that had really been a huge laggard here for most of the year, despite it being the star of the show back in 2018, 2019, 2020. Stocks rallied about 30% over the past 3 weeks. Second best performer in the S&P 500 now on a 5-day winning streak. If it closes in the green today, that'll be 6 straight consecutive highs. Of course, we got to talk earnings as well. We did get Lyft earnings last night, Tom. They were good, surprisingly good. They turned a profit. The street was looking for a loss. The CEO, the president, I should say, profitability on an adjusted basis. Uber, they're going to report after the bell. The street's also looking for a loss. Whether they surprise to the upside remains to be seen. Obviously, Tom, Lyft is much more of a pure play ride-sharing company and has really benefited from that. Uber, a little bit more diversified. That helped it during the pandemic. That could actually hurt it a little bit here going forward. So keep an eye on that. Also getting Roku, Etsy after the bell tonight as well.
Very good. Romain Bostic, thank you so much on the close today, and congratulations. We wanted to do a 1-hour interview with you. We'll compress it right down. What matters to you in this new low-yield environment?
Well, realistically, the only thing that matters is the outlook for COVID and the effect that it's going to have on the economy. And I think that that's really what's been driving the market for the last couple of months. The Delta variant, how pervasive it's been in other parts of the world, and then now it's feeding into with the bond market right now. You know, I'm sympathetic to that Morgan Stanley call that you mentioned about yields being higher by year end, and I do hope that that's going to be the case. But this is all about fear right now, and the bond market is benefiting from flight to quality.
That was a Citigroup call. John, why don't you pick it up and frame it around the magnitude of that Citigroup call?
Well, Morgan Stanley looking for a move back to 160, Citi looking for a move. But do you speak to anyone that thinks they can go much lower than this?
Yeah, so everyone that I talk to on the institutional side doesn't like it, but I think that there's two big factors that continue to push real yields lower and lower. One of those is you look at flows into TIPS, ETFs, and mutual funds, and they're just insatiable. There's a lot of people who want inflation protection. They're worried that inflation is going to be higher. Maybe there's going to be more supply chain disruptions, and you're going to see CPI prints that are a bit higher than what we've had in the recent past, or at least that they'll persist longer, even if they don't go much higher from here. And the second is the Federal Reserve still is buying a lot of the TIPS market. Remember, they only own 7% of the TIPS market in February of 2020. Now they own almost 30%. So you know they've significantly increased their ownership. So liquidity in that market wasn't like it was in nominal treasuries in the first place. And then you add to that these flows from retail investors into ETFs and mutual funds, and suddenly you have a recipe for lower and lower real yields. So, you know, I think that there's a big risk to real yields where if real yields do back up 50, 70 basis points, there's going to be a lot of negatives on people's statements, and maybe they'll rethink those investments, which could push real yields even higher. But we're not there yet because, like I mentioned, fear is still gripping these markets.
They're worried about the opposite. I think this is so important. Together with the fact that the Federal Reserve owns almost a third of this market now, are people buying TIPS with conviction or as insurance? Because if you don't own insurance for inflation in the year ahead, haven't you got a degree of career risk? Isn't that in the mix right now for PMs?
I think here's part of the issue is that there's other ways to take inflation risk. The problem I have with owning TIPS outright, and most of these mutual funds take a lot of interest rate exposure and a lot of interest rate risk, where let's say that inflation does go up to 5 or 6% and stays there persistent from negative 120 basis points to maybe negative 50 or 0. And if that happens, you wind up actually losing 3 or 4% on a mark-to-market basis. So it really depends on who you are. Like TIPS are a great investment and a great inflation hedge if you hold the individual bonds and you hold them to maturity. But owning mutual funds and other wrappers like that mean that you're always taking interest rate risk that maybe that are inherent in that market.
Ira, just to put a bow on this idea of 30% ownership of the TIPS market by the Federal Reserve, has the TIPS market ever been more divorced from giving a true indication of inflation expectation than it is right now?
Well, that's a good question because at 2.3%, which is where 10-year TIPS are pricing inflation at the moment, it's not obvious that's going to be right, and we're going to have 2-ish plus or minus 25 basis points of inflation. The question is real yields being so low keeping nominal yields lower than they should be? You know, you look at a lot of our fair value models based on where fundamentals are, and we are 25 to 45 basis points too low on actual yield. So closer to 150 seems to be a more fair value, but I think it's these flight to quality and some of these technical aspects of both the TIPS market and the nominal market that's keeping yields as low as they are now, and those can take a long time to go away. So this isn't something that necessarily is going to snap back in the next 2 or 3 weeks, but over the course of 3 or 4 months, potentially we can get back into that range, which is much closer to our estimation of fair value for the market.
Ira, great to have you on. Timely conversation. Ira Jersey of Bloomberg Intelligence. Thank you, sir. I want to bring up the nominal curve in Germany, 2s, 10s, and 30s, just to show you where this bond market is right now. Over on the other side of the Atlantic, in the Eurozone, in the German bond market. Tom, yields negative through the whole curve. 2s, 10s, 30s. And that 10-year, back to the depot rate on the ECB for the first time since February, negative 50 basis points. on a German 10-year this morning.
These are the instabilities they confirm with the Swiss franc as well. The Swiss 20-year at negative 0.20%. John, it's very global on the Bloomberg screen. It's clearly global. You got to say it's off of worry about this pandemic.
Lisa, that whole curve, negative.
Just to put this in another way, if you take a look at the total market value of negative yielding debt globally, it's gone up to $16.7 trillion. That's the most ever. That's the most since January of earlier this year. And you're looking at this pool of debt that pays you absolutely nothing. And it raises a question, is it wrong or is everybody else wrong about the dynamism of the global economy?
Well, of course, that depends on when you get in and when you get out. And Tom, I know that's why you're looking a lot more at price and not yield.
Really, really important. Everybody thinks yield, and there's a point within stress and crisis where you shift to a price analysis. Are we there right now?
Yield negative through the whole German curve. 2's out to 30. Saw that a little bit earlier in the week. Seeing it again this morning from New York City this morning. Good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Equity futures down 7. We're negative 0.16% for our audience worldwide. Heard on radio.
With the First Word News, I'm Ritika Gupta. Senior Democrats ranging from President Biden to state legislators are calling on New York Governor Andrew Cuomo to resign. A report from the state attorney general outlined claims that he sexually harassed 11 women. Cuomo could face criminal charges. The one-time Democratic star says he's never touched anyone inappropriately or made inappropriate sexual advances. A new study says that most children who get the coronavirus recover within a week. Researchers who looked at more than 1,700 British children also found that 1.8% have symptoms that last for 8 weeks or longer. That suggests that so-called long COVID may be less common in children than in adults. Securities and Exchange Commissioner Gary Gensler is signaling that there's a path for approving a Bitcoin exchange-traded fund. Crypto enthusiasts say that's a move necessary for taking tokens to the mainstream. In a speech, Gensler said that an ETF that complies with the SEC's strict rules for mutual funds could provide investors with the necessary protections. And CVS posted second quarter earnings that beat expectations. The pharmacy chain also raised its 2021 forecast. Sales rose 14%, thanks in part to a boost from foot traffic generated by the coronavirus vaccine. CVS administered almost 17 million shots in the quarter. And the co-creator of the Oxford coronavirus vaccine can say she's made it now. Mattel has created a Barbie doll in her honor. Dame Sarah Gilbert says at first she thought it was very strange, but now she hopes the doll will encourage young girls to choose careers in science, technology, engineering, and math. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
If inflation did seem to be persistent, the Fed wouldn't hesitate to act, and that you have the tools to deal with inflation. What do you say to critics on Wall Street who say, yes, you have the tool to deal with inflation, you raise interest rates, and then historically plunge the economy into recession?
Yeah, that's exactly the kind of logic, I think, that you want to avoid, that you get too far out of alignment with what's actually happening in the economy, and then you really have to react more strongly than you. If inflation does come back down in 2022, we're in great position for that. We're exactly positioned for that. But if it doesn't, we're not in such great position. So I think for that reason, we want to have some flexibility on this taper.
We had an exceptional Q2.
It's time.
The narrative of the day is strong earnings.
Bloomberg has the numbers.
We have about $12 trillion worth of market cap right here.
Find out who's winning.
Tesla beating across the board.
And who's losing.
That's actually pretty rare for Amazon. They typically don't miss on that scale.
And the voices to give you the important news.
Samsung reported another stellar quarter of earnings.
We are very clearly looking with confidence about what's next.
Bloomberg Television, your home for earnings season.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
There's a variety of things at play, but it has certainly been a challenge for us on staffing at the restaurants, and it's putting pressure on wages, which is what you see in any kind of capitalist system. So employers like McDonald's are now having to pay more on wages.
And many other companies too. That was Chris Kempczinski there, the McDonald's CEO. You can watch that interview in tonight's episode of the David Rubenstein Show, peer-to-peer conversations, coming up a little bit later from New York City this morning. Good morning, alongside Tom Keene and Lisa Bravitz. I'm Jonathan Ferro. Your equity market shaping up as follows. This Wednesday morning, equity futures just a little bit negative, down 7, a softer equity market after an all-time high at a close in yesterday's session. Into Wednesday, we're negative a little more than 0.1%. Yields are lower by a couple of basis points. Keep your eye on this. 115.39. The recent low 112.60 from a couple of Tuesdays ago, Tom. 1.1539% on 10s this morning.
Real persistency in the breakdown of the 10-year yield right now, really from a 118 down to where we are in a matter of an hour or so. Right now joining us, David Rubenstein, host of Peer-to-Peer Conversations, of course, with Carlyle as chairman and co-founder. And this week, I should say, Mr. Rubenstein speaks to the gentleman from Duke, but it's well in excess of 1.9 million when you add in the franchises as well. What is his approach to 2 million bodies?
Well, it's a lot of people to manage, but their system has been largely a franchise system. They own about 10% in the United States of the McDonald's. They want to be an owner so they actually know what it's like to own, and they can give directions based on having been an owner. But most of the employees at McDonald's actually are franchisees, employees.
Well, the franchise and employees, but he has a challenge in this pandemic. Did you speak to him in your peer-to-peer conversation about what do you actually do? Is he going to give out 1,000 cheeseburgers for everybody who gets vaccinated?
Well, they are doing things like that. They are not from vaccination. They're trying to get, their biggest focus right now has been trying to get employees to staff the operations, because it's harder to get employees. Some employees left during the COVID period of time, so now they're incenting people to come back. They're giving $50 for an interview, and if you're at the company for more than 90 days, I think they give you an iPhone.
David, this raises issues for existing employees as well, because they probably want an iPhone and an extra $50 as well. And across the board, you're seeing wages increase. Just today, CVS raised its minimum wage to $15 an hour. This, of course, comes in the heels of Amazon and Walmart. How much pressure is there to pay more? I mean, in other words, do we have a sense of where the cap is of how much higher these salaries can go?
Well, you remember the legislation that was considered in Congress that did not pass would raise the minimum wage over 5 years to $15. McDonald's now beginning wage, minimum wage that they start people at is $11. The legal minimum wage is $7.50. So McDonald's is well above the legal minimum, but they're not quite yet at 15. So I suspect the pressure is such that they probably will have to increase a bit, because it's hard to get employees. Young people have many different things they can do now, and it's tough to get people to work at these jobs sometimes at the beginning, at the entry level.
David, is this the key issue, just getting the salaries, getting the pay high enough to get people into the workforce, or is there something else that's creating this friction that's kept a great deal of people still on the sidelines?
Well, some people are afraid of working in environments where they might not feel everybody that they're working with is vaccinated. So you don't know if everybody coming to McDonald's is vaccinated for sure. So there are lots of issues, but I do think it's largely the case that people have been off of the workforce in some cases for 18 months, and now getting them to come back is not easy. The salary is higher than the minimum wage, but not as high as some people. You just suggested that CBS is increasing to $15. So I suspect they probably will have to do more than they've already done. Remember, they don't control all the wages because only 10% of the employees are theirs. 90% are the franchisees, or the franchisees do take direction from the headquarters. And the principal issue that they're facing as well is how do you get people into McDonald's who ate there, called dine-in. But now a large part, most of their sales are really coming by drive-in or drive-by, and then digital where you're ordering, or delivery. So it's much different than it was just a few years ago.
David, whether it's your conversation with Jeff Bezos or here with a gentleman from McDonald's, it's about scale. David Rubenstein on scale. Is it overrated, overplayed?
Everybody else, and they can afford to make changes, and then they can move it out across the country and around the world. The reason that McDonald's has done so well is that everything is the same around the world. So when you go to McDonald's in Paris, where the biggest McDonald's in the world is in the Champs-Elysees, or you go anywhere in the world, you're going to get largely the same tasting product, and people like that consistency. That's why they've done so well.
I did not know that the biggest McDonald's in the world was in Paris. David, thank you for that.
Okay, it's in the Champs-Elysees.
There we go. I'll make a visit. David Rubenstein, host of Peer-to-Peer Conversations and Carlyle Group co-chairman and co-founder. You can catch that conversation tonight on Bloomberg TV from New York City this morning. Good morning. Alongside Tom Keene and Lisa Brammitz, I'm Jonathan Ferro. Your equity market shaping up as follows. We're down about 0.1% on the S&P. We're negative 6 points on the S&P 500. Going into the opening bell a couple of hours away with an ADP report in between. And shortly after the opening bell at 10 Eastern time, we hear from the Vice Chair of the Federal Reserve, Mr. Richard Clarida.
Yeah, it's going to be interesting, John. I was at the McDonald's in Paris. I came out of Vendôme after spending $41 on a martini, and I just felt I had to.
You felt like you needed a cheeseburger after that, did you, Tom?
The Amex in order. I thought Redo, keeper of the Amex, would be upset. So, we did a number two, a number deux.
Well
I think
done.
It's deux, value
you
meal.
Get that French
meal
out,
de
so.
value. We did. It's given away.
You want to look at nominals or real stateside, Lisa, or do you want to look to Europe?
Right now, I want to look at nominal yields across the board, because real yields, I think, are confused in part by some of these technical factors, looking at the tips and the fact that I just can't get over the statistic that Ira Jersey threw out. The Federal Reserve owns 30% of the tips market in the United States. So how much of a signal can we get? But really what this shows to me, are we talking enough about the distortions that the Fed is creating with their ongoing bond purchases, and whether they can stop? What happens if they stop and there is a material dislocation in the market? What's their tolerance for that, John?
So the next time someone says, what is the bond market telling us, will you have a different answer to doom, gloom, and real fears about the future and economic growth?
No, I'll still have those.
You'll still have those?
No, I mean, honestly, look, I think that's an underpinning, right? I don't know what the exact message is, except for it's a very manipulated market.
I've always enjoyed your company, Lisa. It's always authentic. It's always real. Tom, nothing will change.
I don't think it's a manipulated market.
You don't think this is a distorted market right now?
It's distorted. That's different than manipulated.
Okay, that's true.
Okay, fair.
That's true.
Okay,
the Swiss bank owns more Apple than anybody in America except Tim Cook. I mean, these banks are making decisions. That is distorted. It's not manipulated.
Yes.
That's a conscious decision.
There is a legal aspect to that.
I wasn't suggesting an illegality.
Yes, you
Lisa,
were.
I understand. Maybe Tom didn't.
Don't change, Tom. Don't
Down
change.
6 on the S&P, negative 0.14%.
She beat me last night at
Bit of
Boggle.
family drama going into the final
Boggle.
hour of this program.
I
This is
can crush it.
Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze market. A question or visit SearchGo to find answers now.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's a bull market, but there's a lot of violence going on. I think the market can still move higher. It's just going to happen more on the cyclical side.
A pullback in yields could cause some of that volatility.
The data fog is starting to break, but it's not broken.
The Feds have not spoken about this, but they will not be happy to see the 10-year approaching 1%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene, a simulcast with Markets on the Move on radio, on television. Jonathan Ferro, Lisa Abramowitz, and we are looking at a set of things. Clarity of speech later. Okay, maybe. The virus, maybe. John, I'm looking at yields and the price of oil just moments ago down to new weakness.
Nominal yield right now, 115.22. 2 Tuesdays ago, we had 112.60 on a nominal yield, Tom. You've mentioned the real yield, record lows in today's session once again. And crude, keep an eye on the lows of yesterday, 69.19. Right now, WTI, 69.19.
All sorts of little nuances here, John. Let's go to one narrow. Maybe Richard Clare is not looking at this, but Swiss franc speaks volumes, confirming this tentativeness.
Just how live is this Jackson Hole meeting? I know they can't make a real decision, but how much attention should we be paying to this Jackson Hole meeting and a speech from Chairman Powell? Vice Chair Rich Clowder, if he takes the same line as Governor Brainerd, I think we can look through it all, through to September, Tom. If he takes a similar line to, say, Governor Waller, then we've got a very interesting setup going into Payless Friday.
I would call that less than likely, but we will see, and that's a mystery at the Peterson Institute. We'll have full coverage of that, particularly Bloomberg Economics with Bloomberg News. Lisa, the overlay here, and at least the analysis is, all of this angst is about the new pandemic.
The idea here that the Delta variant is gaining steam and creating new shutdowns in certain places, particularly in China, where you get the likes of Nomura downgrading their economic expectations for China. Look, Tom, when you're talking about yields, how much are the ultra-low yields signaling that the Federal Reserve is correct in its assessment and its caution of raising rates or tapering its bond purchases, and how much is it a consequence of the Fed signaling that it is not going to move anytime soon, and so these distortions will continue? And that is a huge difference, right, Tom?
It is. It's a huge difference, no question about it. John, I want to get to our esteemed guest, our interview of the day on the equity markets. Let's look at the data quickly, John, and then I want to frame why Tobias Lefkovich matters. Futures -8, Dow futures 79.
39. Here's the call from Citi. They're looking for a move back to 2% through 2022. So you take the bond market move and you try and figure out, okay, what does it mean for this equity market? Long Japan, apparently, keep the overweight on the UK, and you cut US equities to underweight. Tobias Lefkovich joins us now from Citi, the chief US equity strategist, and Tobias is looking for 4,000 year-end on the S&P 500, all-time highs that are closed yesterday. Tobias, walk me through the work that you and the team, Robert Buckland over in Europe, is doing with his team over at Citi, and why you're just a little bit more cautious on US equities together.
Sure. So let's start with the discussion you guys were having before about the bond market. Bond yields have had enormous impact on how you think about cyclicals versus growth, versus defensives versus growth versus value, and this has been what's really changed in the past 3 months as we see the bond yield go in. Now, again, there's been a lot of discussion around what the impact, distortion, et cetera, of the Fed has been, but keep in mind, central banks globally have been keeping suppressed rates since really 2008, and what that suggests is that they don't have confidence in kind of long-term sustainable durable growth. So as a result, risk premiums are higher, which is something people don't talk about when they talk about negative yields, for example. And it is important to valuation markets. In an environment today, and I think it's like a really critical thing to understand, in 2008, in our last recession, 30% of the S&P 500 was comprised of, in terms of market cap weight, was comprised of deep cyclicals, industrials, materials, energy. And 30% was secular growth, including IT, including media, entertainment, including in digital retailing, if you want to think of it that way, and healthcare, which is growing simply because of demographics. Today, that number is like 55 versus 15% in favor of growth. So the U.S. is a heavy growth market. And if you believe bond yields are going to edge higher, then growth stocks are going to take a little bit on the chin. And that's why you'd probably want to be in more value-oriented areas, which is what Rob Buckland, our global chief equity strategist, was suggesting with his note. One last point, Jabaz Mathai, who's our rate strategist, looking at that 2% number, really pointed out very significantly that because tax collections really stepped up meaningfully in June, remember we distorted the time frame for collecting it. Instead of April 15th, it was June 16th. The Treasury was flush with cash going into July and only issued $94 billion worth of bonds. $80 billion alone was just picked up by the Fed. So you left $14 billion of new issuance for the rest of the world. That's going to have impact on that bond yield, and it's another one of those distortions that are sitting in markets today.
115.22 on a nominal 10-year yield. You guys are looking for that move back towards 2%. So Tobias, for an international story, I understand from Robert Buckland, Japan, UK, deep value, I've got all that. From a US perspective, Tobias, can you just walk me through the sector preference right now for you and the team?
So we're a little bit mixed on that. We do like capital goods, we do like consumer discretionary, but very specifically within retail and consumer services. We're not chasing consumer durables and apparel. We're not chasing autos. We think those are probably not interesting to us. And then we like financials. We like banks. We like insurance. More neutral and diversified financials today. And those are, those are more value cyclical oriented groups. So from that perspective, We are there. We're not totally out of growth. We're not saying run like hell, because tech, hardware, and equipment, we're still in overweight on. We do have a downgrade watch there, but we're still in overweight because we think it's part of the capital spending cycle.
These glide paths, Tobias, to the Citigroup outcome, can they be affected with stability? Or do you see significant volatility where along the path we enjoy VIX 30 or even worser?
Is that a word, worser?
CFA level 2.
But let's kind of go through this process. I'm not actually worried if the VIX is at 30, and I'm not actually worried if the VIX is at 15. Where I get very worried is between 20 and 30, because that tends to be the problem area for the markets historically. You have about, if the VIX was at 15 or 35, in both instances, you have about an 88% probability the markets will be higher 12 months later. So it's not those edges, it's crossing over in that 20-30 range that you need to be a little bit more worried. And I do think you have some potential for volatility. There are 4 catalysts that are disconcerting, if you like, for us, that possibly could all coalesce around September. Tapering, inflation being a little bit more persistent, profit margin pressures because costs go up because of supply chain challenges, for example, and you can't as easily make it up on pricing. And then lastly is something nobody's talking about, which is taxation. We're going to see corporate taxes going up, and it's going to impact 2022 estimates for the street. And that has been the real driver for the market, has been really strong earnings. Problem is the guidance isn't that good anymore. The revision trends are at historic peaks and is unlikely to be, continuing to rise at this pace. And that will worry some people, especially when sentiment is so bullish. Our panic euphoria has been euphoric for a while. The complacency out there when we talk to investors, on a qualitative basis is very palpable.
There's a lot of potential headwinds, and yet it doesn't seem to be coming together in some sort of big swoon, as a lot of fund managers would like to see, so they can go ahead and buy that dip. And I do wonder whether this just means we've brought forward so many of the returns, and that going forward over the next 5 to 10 years, returns on the headline S&P 500 are going to be pretty muted. What's your expectation there?
It's a really good question, Lisa. One of the things we've been showing people is that if you look at the household sector's equity exposure as a percent of their financial assets, is around, actually done exactly what you just suggested, is brought forward a lot of the return. If you look at that today, it's talking about kind of like a 0% return compounded annually over the next 10 years. Now, that shouldn't shock people when they hear that, because remember, when you hit your highs in 2000, you didn't get back to that level until 2007. So we do have periods, and I'm relatively certain about this, that over the next 10 years, we will have a recession. And when that happens, earnings often drop 30%, and so do markets. So to say over the next 10 years, you might not get any return in equities on the S&P 500, isn't that crazy, even though it sounds crazy. But it means that you probably have to be much more of an active investor, and passive vehicles may become less interesting to investors over the next decade.
We had a recession over the last decade. It lasted a couple of weeks. It's unbelievable. Tobias, going to catch up, sir. Tobias Levkovich, Citi Chief, U.S. Equity Strategist. The official numbers there, Tom. Literally, it lasted a few weeks. The recession of last year.
Well, that's NBER, and they've got their own formulas for how we do this. I really underplay that measurement, John. What I'm focused on are the markets now, and I like what Tony Dwyer says at Canaccord Genuity. If it's a recession, that's not good for stocks. If there's no recession, you got to play.
44.23 is where we closed yesterday. Tobias Levkovich over at Citi looking for a move to 4,000. And just to reiterate that call from Citi, the team led by Robert Buckland over in Europe, Tom, the international aspect to all of this, if we get a move back to 2%, the preference is international. It's the UK, it's Japan, I get all that. But if you have a 70 basis point move on real yields in America, I do wonder the broader risk tolerance, more broadly, whether the sector preference really makes a difference in that kind of environment, Lisa, whether we just get one big downdraft.
Yeah, well, I think it depends on the pace also. I mean, I've been sitting here trying to wrap my head around what would actually have to happen for real yields to move up by 70 basis points. Would it have to be incredibly good news? How disruptive would it be? Would it be gradual? I mean, these are all things that could determine all of this. I mean, I'm just thinking through the mechanics of it, and it's so different depending on what it is.
Could have a situation, Lisa, where economy is good and market is bad. we've had a situation where the economy's been bad and the market's been good.
Arguably, that's what people hope happens, that people hope that it gets brought into the economy, and that, frankly, you could see a sell-off, a downdraft, but it's temporary in the markets as people reassess and sort of recalibrate with higher yields.
Yeah, we're talking about absolute performance here, Tom, or just relative outperformance in a down market if we get a move like that.
Absolute relative, and Steve Majors 1%. Maybe you visit there before you go to 2%.
114.89 right now on 10s. In about 4 minutes, an ADP report in America. Michael McKee is going to join us to break that down a little bit later. From New York City this morning, good morning. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Researchers say that vaccines targeting 8,000 people in England, they found that vaccines protection against development of COVID systems was 59%. That is down from 83% earlier. That indicates the antibodies raised by current shots are less effective. In China, the widest coronavirus outbreak since the start of the pandemic is hampering tourism and spending during what's the peak summer holiday. That has analyzed half of China's 32 provinces. And the British Navy says a potential hijacking of a ship off Iran has ended. Unidentified people were said to have boarded the ship yesterday. Those boarders were said to leave today. The incident took place days after a possible drone strike hit an Israeli-operated ship in the region. 2 sailors were killed, and the UK says Iran was probably behind the attack. Congressional Democrats reportedly are seeking $500 billion in climate damages from big polluters, according to the New York Times. Draft legislation calls for a tax on companies such as ExxonMobil, Chevron, and those other big oil and gas corporations. The bill would direct government agencies to identify the companies that released the most greenhouse gases into the atmosphere over the last 2 decades. And it's the question Wall Street is, well, always asking, how long will Jamie Dimon stay? The billionaire CEO of JP Morgan Chase sort of gave an answer today. He told Fox Business he sees himself staying in the job for another 5 years, but not 10. Global news, 24 hours a day. I'm Ritika Gupta. This is Bloomberg.
I assume you have a lot of people saying the food isn't as healthy as they might want it to be. Is that the biggest challenge, or just growing the company?
Ray Kroc had a famous line, if you're not green and growing, you're red and rotten.
Friday is Jobs Day.
For every positive thing you point to, there's something less positive.
The June report fell short of estimates.
The unemployment rate goes up to 5.9%. It's one of those things where you say it's good news. The unemployment rate goes up.
What should we expect to see from July's report?
A lot of reshuffling. We'll continue to see hiring at large pace.
Are people looking to return to the workforce?
Businesses have a lot of jobs to fill. They can't find workers.
The July jobs report, Friday on Bloomberg Television and Radio.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Big downside surprise on the ADP report this morning. Good morning. 330 the number, 690 the estimate. Here's the price action. 113.24 the yield on a 10-year, a 113 handle. 2 Tuesdays ago, 112.60 was the recent low. We're just about to break through 113 right now. We're down 4 basis points on a session. Your dollar is weaker, as Tom pointed out. The dollar index briefly through a 92 handle. Euro dollar 118.70, advancing by 0.06%. Equity futures just a bit softer here, down 9 points on the S&P 500. We're down by 0.2%. It is a downside surprise, Tom Keene, on the ADP report. 330 is the number, 690 was the estimate.
Downside surprise, and we go granular. Only Michael McKee can do that, John Farrell, because beneath the headline data of the ADP is other data. Do you believe in it? Is there veracity to this granular data of ADP?
Well, you take a look at the underlying data, Tom, and the conclusion is the same. It's an ugly report. The issue is, do you believe it? As you said, the markets at this point don't seem to be reacting in a way that suggests it really matters, and that's always been the problem.
I got a 112.91 on the 10-year. There's something going on.
Well, they're looking at the number and they're worried about it, but the ADP has not been an accurate forecaster in terms of numbers. In terms of direction, yes. And last month, the direction of ADP was lower, and the direction of private sector hiring eased a little bit. But let's take a look at some of the numbers underlying the ADP report this month. Small businesses, 91,000 jobs added. That compares with 215,000 a month ago. Medium businesses, 132,000. There were 236,000 1 month earlier. And large businesses, only 106,000. There were 240,000 added. So about half the hiring in each of the categories over the past month. Now, is that because ADP doesn't count correctly, or is that because hiring really slowed? That's going to be the major issue for the markets. 318,000 service-providing jobs, and we were expecting that. We were expecting major hiring in leisure and hospitality, but only 139,000 jobs according to ADP during the month. That compares with 332,000 the month before. So a lot of data from ADP suggests that maybe July was a soft month and people did not want to come back to work. But remember, a lot of states cut off those extended unemployment benefits during July. Didn't seem to have an effect in this data. Now, you're going to have to tune in at 10 o'clock for Alex and Guy and me, because we have two data points then. One, of course, Rich Clarida, the vice chairman of the Fed, will give us his views, and maybe this will affect his views. But two, we get the ISM services report, and that'll tell us a little bit more about hiring in the services industries, and the services industries are a real disappointment in the ADP numbers.
We're conditioned by experience, and often we only remember the extremes. And Mike, the recent extreme is a spring repeat. That's what's on the minds of many people. Tom's been talking about it all week. You look for something close to 1 million on payrolls and you get something nowhere near. Going into Friday, Mike, how are we set up? What are the estimates?
Well, the estimates were 875,000 for total jobs created. Now, will that come down after ADP? Sometimes it influences some of the forecasters. The private sector job creation number a little bit lower than that. We just don't know at this point. What we're all flying blind because we've never shut down the economy in one fell swoop and tried to reopen it. It is becoming clear it takes a lot longer to reopen the economy and to match people to jobs. A lot of retirees in higher paying, perhaps more senior positions, a lot of openings at the low end, but you've got jobless benefits, you've got child care questions. So, how long is it going to take to get this sorted out? The Fed doesn't know, we don't know.
Mike, you said that it doesn't seem to be helping that certain states ended the enhanced unemployment benefits. Do we have granularity that shows that in those states there were not additional job gains relative to the other states?
We don't have that yet. The number of claims that are still being paid in those states, it's about 50-50. Some of the states saw an increase. Some of the states did see a decrease. So there's no firm evidence one way or another that it actually sends people back into the labor market and helps them get jobs.
Mike, the reason why I ask is because a lot of people are looking to September when the enhanced unemployment benefits roll off. If we do not see material gains in those states that have already ended them,
Lisa, the problem is, and here I'm going to be the economist with multiple hands, is there are other things that are going to happen in September, particularly schools reopening. And now there are questions about that, of course, with the Delta variant. But if schools are reopening, that will free up people who had to stay home because kids were in virtual school, and they could come back to the labor force as well. So it's a little bit hard to tease out which effect is going to be the greatest in September. We might see a little bit of return to work in August because schools are opening in many districts. We'll just have to wait and see.
Mike McKee, thank you, sir. Teeing up the morning ahead of us as well. The ISM services print coming up at 10 Eastern, alongside that speech from Vice Chair Clarida. And I keep repeating this. He has license this morning to say basically whatever he wants, because this speech apparently will be on outlooks, outcomes, and prospects for U.S. monetary policy. Tom Keene, that's a pretty broad one.
Mike and I probably disagree on this, but John, I am going to respectfully suggest that with his academics with Gertler from years ago, this is a guy that's going to frame what ex post means. The new data, wait for the data, wait. Maybe he's going to talk about the patience of this central
This
bank.
new framework, Tom, largely attributed to Vice Chair Clarida. We haven't heard from him in a speech, at least, I think since May. I think that's important. We've got to hear from the Vice Chair. And will he try and reclaim the narrative away from what we've heard from the likes of President Bullard, who's made a lot more noise over the last several months?
My answer there is I'll give an opinion, yes.
Lisa, would you agree?
Yes, I would agree as well. Look, I'm just looking at this data, and I'm looking at the market reaction to the data, and I'm wondering whether basically this pushes the potential taper to January. How many job reports does the Fed need to see before they're comfortable tapering rates, tapering their bond purchases? I think this is important. I mean, if we get a bad jobs report on Friday, does this push the potential taper into 2022?
Well, that's the question, isn't it? It's not about the ADP report. If the NFP, if Payrolls Friday looks like this, we have a very different conversation. And Governor Brainerd starts to look even smarter than Governor Brainerd already is. We wait for the September data, that takes you to October. But a lot of people, I think it's still the base case for many people, Tom, is that when do we get a start? In December, and an announcement maybe in September? It's kind of into 22 anyway, isn't it?
I'm going to wait for the data, and one of the great observations.
I'm doing the same thing.
Yeah, one of the great observations I've learned, Michael McKee, at the same time, the job formation and what's going to be necessary on Friday is to see, okay, maybe we've staunched the job decline, but where's the beef? Where's the job formation?
Let's use that word, Tom, asymmetry. Let's extend that further. What changes the game more? Huge upside surprise or huge downside surprise?
I think the market is priced in the whisper numbers upside.
Looking for a big one, are we, Tom?
The loud screaming number is going to be downside.
Lisa, your view on that?
I think the downside surprise will send equity markets lower, which is what we're seeing right now. And I think that is a distinction between lower yields and higher equity valuations.
Equity futures down 11 on the S&P. We're negative 0.2% from New York City this morning. Good morning, alongside Tom Keene. Lisa Abramowitz, I'm Jonathan Ferro. On radio, on TV, this is Bloomberg.
Blast off. China's first manned mission in 5 years is on its way. 2 veteran astronauts and 1 newbie are making their way to Tianyi Space Station, which means heavenly harmony. They're travelling in the Shenzhou 12 spaceship, launched by a Long Mark 2F Y-12 rocket.
我们一定服从命令，听从指挥，沉着冷静，精心操作，圆满完成神舟12号载人飞行任务。
The crew members will be staying at the station for 3 months. They'll be carrying out experiments, testing equipment, maintenance and more.
2022年完成空间站的在轨建造，建成国家太空实验室。之后，空间站将进入到应用与发展阶段。
Once completed, the space station will allow for stays of up to 6 months, just like the International Space Station. China has big ambitions for its space program. Last month, it landed a probe on Mars that carried a rover, the Zhurong. It sent 11 astronauts into space and 2 years ago sent the first spacecraft to land on the far side of the moon.
Here on Earth who are wondering, why are we investing all this money in space, this time in space? Talk to us about how you believe this will actually help benefit us here on Earth.
We're building infrastructure. This is a road. We're building a road to space so that future generations
never sleep. So stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
Live from New York City for our audience worldwide on TV and radio, alongside Tom Keene and Lisa Bramwitz, I'm Jonathan Ferro. This Wednesday morning, waiting for more data in America, 10 a.m. Eastern Time, the ISM services read and a speech from Vice Chair Clarida. Here's the market reaction to a downside surprise on the ADP report, 330,000 against an estimate of 690. Yields lower by 3 or 4 basis points to 113.73. Had a tiny little look at 112. 112.60, the lows of a couple of Tuesdays ago, 113.40, 113.20 right now. In the FX market, euro dollar 118.72. We're positive there, 0.1%. Dollar weaker off the back of that with yields lower. Your equity market also a bit softer here, down 12 points, call it 13 on the S&P. We're negative there, Tom, about 1/3%, 60 minutes away from the opening bell.
Yeah, the observation besides equities finally catching up with everything else is, John, I see the 2s10, the vanilla spread, the difference in yield between the 2-year and the 10-year gives way. We may touch that third week of July flatness, John, that we saw. That's significant for the banks, isn't it, John?
Treasury refunding, something else we should be watching as well, Tom.
Oh,
just
please
some
explain
headlines.
that. I could care
the Treasury
less.
to sell 126 billion of 3, 10 and 30-year debt in refunding. They see coupon auction size cuts as soon as November. And Lisa, we've been talking about peak everything, peak fiscal, peak monetary policy. Let's talk about peak debt issuance as well in this Treasury market.
And this could actually provide a support to Treasury valuations and actually send yields that much lower on the balance, especially if the Federal Reserve decides not to taper its bond purchases. I mean, just think about this. Less supply of bonds, same amount of bonds that the Fed is purchasing. Do the math.
Yields. 113. Tom Keene, just south of 114 right now.
113.73.
I'm doing the maths as Lisa told me to do the maths.
You got the right guests right now with the right questions. We could really spend a good amount of time on wage dynamics and labor dynamics in America with Thomas Purcelli, RBC Capital Markets Chief U.S. Economist, and he joins us on radio and television this morning. Tom Purcelli, I'm going to cut to the chase of the asymmetry of any labor report. and it's one part about, well, people maybe not getting job growth as much or losing jobs faster. There's two dynamics always in a labor report. Is this economy about the inability to form jobs?
No, I think yes. That is a challenge. I think we know that. We can see that in the job openings data. I mean, we have a staggering amount of job openings, sort of roughly equal to the number of unemployed, and we just can't find those matches. So yeah, I do. I think that there's some element of truth to that. Look, I know people are, my inbox is already filling up with, hey, what does this mean for the recovery and et cetera? It's one report that missed the mark, and it's a report that hasn't done a really good job of telling us what's going to happen with private NFP, which we'll get on Friday. I mean, yeah, it did a great job last month. The numbers were nearly on top of one another. But other than that, the misses have been staggering, right? I mean, it's missed by between 400,000 and 500,000. So I wouldn't take much away from this report as it relates to this coming Friday. I mean, we're still looking for 700,000 private jobs. That feels like a pretty good estimate. In fact, if anything, there's a really favorable seasonal factor in play for this coming month. So I think we feel comfortable about this. Okay. I think part of the challenge, though, is Fed Governor Waller I think really put a sort of a bullseye on this report, in his speech the other day. So I think maybe expectations are going to be very elevated with regard to this report, but I think it'll probably wind up coming out and at a minimum meeting expectations.
Tom Perselli, the single sentence this morning for me was Paul Donovan, always brilliant over at UBS, and Paul Donovan said, "Wait, are we counting jobs correctly in the modern economy? Are we counting digital jobs, TikTok jobs, and all the rest of it? Do you actually believe the data now, or are we in some new paradigm?"
Yeah, I think that it's a fair thing for all of us to sort of really dig into. I don't think there's any question about that. But I think the problem is this. If we are in the midst of a shifting paradigm, the reality is people are going to be very slow to sort of wake up to the reality of the new paradigm, which means that you're left with having to deal with, sort of all of the data that we have been using prior. As it relates to Fed policy, I would love for them to sort of drill in and sort of understand, different labor dynamics beyond just, the payroll report and what some alternative data are telling us. But that's not something that's going to happen on the fly, particularly not right now. So for the Fed, as it relates to the sort of the fate of policy, it's going to be entirely about what happens with these payroll reports. Even if, sort of behind the scenes, there are actually, the labor backdrop is showing more strength. That's not going to equate for this Fed with regard to their decision to taper or their decision to hike rates.
Tom, help us navigate the Fed speak. Vice Chair Clarida at 10 Eastern. What kind of approach are you looking for?
Yeah, I look, we like Clarida a lot in terms of, sort of being a guidepost for what the conversation that's happening within the Fed. I mean, I think Waller really gave us a good sense for that the other day. And in fairness, to be totally fair to all of these Fed officials, I mean, they all speak with such regularity now. I think we get a really good sense for what's happening behind the scenes as it relates to these conversations. So, Clarida has done, I think, the dutiful thing in his time as vice chair, which is to say, more or less representing what the chair is saying and thinking. Does he break new ground here today? Frankly, I would love for him to break new ground. I would love for him to be more aligned with what Waller was saying earlier in the week, because I think directionally, I think that is where we're going. I think Powell is probably going to be the one that's late to the party on that. And in fairness, and I've said this to you all before, I think he probably has to be a little bit late to the party. I don't think anyone wants him, basing what is going to happen on policy on what his forecast is. I think that they want him to sort of, just hit it down the middle as much as he can every time. But again, as I think it relates to sort of the changing and the weaving dynamics of the economy, I think that the other officials, including Clarida, think that they're usually better at giving us a sort of a sense for what they're thinking about these changing and weaving dynamics. So I'm looking forward to his speech. But again, I have to say, like, my new favorite Fed official is Governor Waller.
Just to move things along, I'm not surprised, Tom. Some people might say that Chairman Powell's merely reflecting what the Vice Chair is thinking, but we'll leave that for another day. Let's talk about the sequencing you're looking for. We've had 2 outlier calls on this program in the last couple of days. We've had one who thinks we can get a June rate hike, June of next year, and another from Natixis who said no rate hike through the whole of this presidential administration. Tom, what are you looking for? The kind of sequencing, your base case at the moment?
Yeah, so our base case is that they tee up tapering perhaps as early as the November meeting. Again, I would love for September to be right. I think that's way too early. So we think that it could happen as early as November. But again, I have to be frank, whether it's November or December, that's a distinction without a difference in my humble opinion. But again, so it's November, December, they teed up. They start either in sort of December or in January. And then they tie it up by the middle of the year, and then shortly thereafter, they're raising rates. So we have one hike built in for next year. But again, Jonathan, I think you're asking the right question. I mean, let's all be clear on this. I think it's a really important point. If you think about this new flexible average inflation targeting framework, you can easily make the case that maybe FAIT has been achieved already, and Loretta Mester has effectively said that idea. We agree with her on that. And then think about next year. Think about the Fed's forecast for the unemployment rate next year is 3.8%. I know people think that I'm like this big, economic bull out there. Okay, but the bull is then aligned with the Fed because that is pretty much my forecast. I mean, I have 3.5% on the unemployment rate by the end of next year. Yet, are you going to tell me that 3.5%, which is, or 3.8% to use the Fed's number, which is below their long-run estimate of funds, and FAIT having been achieved equates to no hikes in 22? I mean, that is inconsistent. And so I think people are looking for catalysts to get the market to move. I'll give you a catalyst that I think could be very interesting. And I don't think it's econ data. I think even if payrolls blows it out, I don't think that's what's going to do it. I think the September payroll, I think the September FOMC meeting, I think could be very interesting. As I think everyone appreciates, there's 7 Fed officials looking for a hike in 22. It only takes 2 more officials moving off the zero lower bound to get that median to move. I wouldn't be the least bit surprised if something like that happens. In fact, I would say that that's the area that's ripe for continued movement within the SEP in general. Sorry?
Tom, that's such a good point. Such a good final point. Tom Porcelli of RBC. Tom, great to catch up, sir. Thanks. As always, looking forward to that speech from Vice Chair Clarida a little bit later this morning as well. Lisa, it won't take much to move that median dot. I think that's a really important point.
And the Fed looking at an economy where it's faith-based still. I'm just trying to understand getting down to 3.8% unemployment. I'm looking at what we're seeing in the job gains that have been disappointing repeatedly. When are we going to start to see progress? Is it going to be in September? Is that really going to be the case, John, especially with the Delta variant?
Progress is, Lisa?
Well,
you tell me what that actually is.
No, I can't. But I will say that upside surprises in some of these labor market reports, the blockbusters, those numbers that we've been expecting, when are we going to see them on a repeated and consistent level? We're not seeing them today.
What we're seeing right now is yields lower by 3 basis points to 114.23. Tom, sometimes it takes a while for the market to remember that they don't care about the ADP report. 114.23 after threatening to break 113. A couple of minutes ago.
114 versus where we were weeks and weeks ago is different. John, I would focus on what happened yesterday at American Airlines and Spirit Air. It was an absolute joke. I mean, I don't know what happens, who's who or what.
What happened, Tom?
But X% of their pilots couldn't get into the sky because of massive staff dislocations. How do we guesstimate a Friday jobs report with a historic standard error you could drive a Mack truck through when we're dealing with that national environment?
What you bring up is a perfect example that demand isn't a problem here, right? There were people waiting to get on those planes.
It's all supply dislocation.
Supply dislocation. Yeah. So how should the Fed respond to a world that is still driven and dominated by supply disruptions?
Wait for data. That's what Clarida's going to say.
Priya Misra of TD will be joining us in the next hour on the bond market and working out, trying to predict, getting a crystal ball and looking into the thoughts of Vice Chair Richard Clarida before he delivers that speech at 10 a.m. Eastern Time. Full coverage on Bloomberg TV and radio. Heard on radio, seen on TV with Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. Senior Democrats, ranging from President Biden to state legislators, are calling on New York Governor Andrew Cuomo to resign. A report from the state attorney general outlined claims that he sexually harassed 11 women. Cuomo could face criminal charges. The one-time Democratic star says he never touched anyone inappropriately or made inappropriate sexual advances. A new study says that most children who get the coronavirus recover within a week. Researchers who looked at more than 1,700 British children also found that 1.8% have symptoms that last for 8 weeks or longer. That suggests that so-called long COVID may be less common in children than in adults. Securities and Exchange Commissioner Gary Gensler is signaling that there's a path for approving a Bitcoin exchange-traded fund. Crypto enthusiasts say that's a move that's necessary for taking tokens to the mainstream. In a speech, Gensler said that an ETF that complies with the SEC's strict rule to mutual funds could provide investors with the necessary protections. And it was a rare quarterly earnings miss for General Motors. The automaker was hurt by the $800 million cost of the recall for the Chevy Bolt battery fires. On the other hand, GM raised guidance for the full year. The company also said that supply chain challenges are continuing in the second half. And CVS posted second quarter earnings that beat expectations. The pharmacy chain also raised its 2021 forecast. Sales rose 14%, thanks in part to a boost from foot traffic generated by the coronavirus vaccine. CVS administered almost 17 million shots in the quarter. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Rishka Gupta. This is Bloomberg.
Said was we need to make them in America. Does that include overseas companies making them if they have the plant in America?
I would certainly be in favor of them having operations in America. Absolutely. You know, Samsung, TSMC, there are companies that are in allied countries, and you know, we certainly want them operating in America and producing chips in this country, yes.
So we have a significant chip issue, but there are other supply chain issues as well. As I know you're monitoring what's going on. Where have you seen other problems in the supply chains right now in the United States that need to be addressed?
Particularly in home building supplies, you know, lumber and all the related supplies, glue, adhesives. And you see it playing out. You know, home prices are high. If you go to Home Depot or Lowe's, you'll see prices are a little bit high. So, and that's all because of the lack of supply, just disruption.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
We had an exceptional Q2.
It's time.
The narrative of the day is strong earnings.
Bloomberg has the numbers.
We have about $12 trillion worth of market cap right here.
Find out who's winning.
Tesla beating across the board.
And who's losing.
That's actually pretty rare for Amazon. They typically don't miss on that scale.
And the voices to give you the important news.
Samsung reported another stellar quarter of earnings.
We are very clearly looking with confidence about what's next.
Bloomberg Television, your home for earnings season.
the sort of technology landscape has gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Savannah's. Good morning, everyone. Lisa Bramwitz and Tom Keene in a special moment for us right now. We do this with the markets. The yield of 1.1373 speaks volumes in 3 basis points. Some I'll get it out. 3, 2, 1. Deterioration in the equity market. Right now, David Weston knows Lyric is spelled with a Q. That's an electronic vehicle that General Motors will give us here in a month or so. And David Weston, the 300-mile range, that gets you halfway to Detroit.
I've driven that drive many times. Thanks so much, Tom. And leave it to you to really know how Lyric is spelled. Good for you. You know who's going to be happy about that? Mary Barra. She is the chair and CEO of General Motors, and she joins us now live from her headquarters in Detroit. Mary, thank you so much for being back with us. I know you're going to say, and you're going to be right, that the second quarter is just one piece of a longer arc for GM. But to take that one piece, you did very well on revenues, better than people expected. You set a new record on EBITDA. You fell short of what people expected on earnings per share. How much of that was because of the $1 billion in costs on a recall?
Well, certainly that's going to have an impact. But again, we're always going to do the right thing for our customers. We prioritize their safety. And so it was the right thing to do. We've learned from it. We know it's a very unique situation when 2 manufacturing defects that are quite rare happen in the same cell that causes the potential for a fire. So we're going to address it, and we'll move forward. I think it's also important to note when we look at our Ultium platform, that is a whole new battery system, and that's what underpins the Hummer EV that will be out yet this year, the Bright Drop products, and then, of course, next year with the Lyric.
Well, that's what I was going to ask about. How do you make sure that this doesn't happen? You're making a substantial investment in electric vehicles. You've actually advanced the time that you're going to invest some of that money, $35 billion, as I recall. How do you make sure you don't have this problem again?
Well, of course, anytime we have an issue, we have an outstanding engineering team, and they look to make sure we never repeat that issue. But I also think it's important to note that as we go forward, we've announced 4 battery cell plants. Those will be joint ventures. GM brings our manufacturing expertise and our quality processes, and I think that should give people great assurance as well.
There's another headwind that you've been facing, and that's semiconductors, as all the auto industry has been facing. Give us an update on that. How many fewer, particularly trucks, are you going to make in the third quarter than you otherwise would because of the shortage of semiconductors?
Well, I would say, we increased our guidance for the full year. So I think that shows our confidence that we're going to continue to perform on top of an exceptionally strong H1. But we'll be very fluid. Right now, we work, and it's on a, daily for the team that's working on it, but weekly from a leadership team. We're looking and making sure we understand the semiconductor situation, and we're allocating chips to our highest demand to take care of our customers, and also the vehicles that are in plants that are capacity constrained, and that is especially our full-size trucks and SUVs. So you'll see us continue to do that. There is a lot of growing uncertainty because of the Delta variant. We've seen an impact in Malaysia, and we've mapped it out in detail. And so we're working to share our safety protocols because we have the experience to say when people follow those protocols, they can be in their manufacturing operations, or whether it's design or R&D, they can do that safely. So we're going to continue to share that, work with our tier 1s and all the way down to our tier 4s to make sure they have that benefit, and then we'll just keep maximizing production.
So, Mary, I'm glad you brought up the Delta variant because we're all trying to come to terms with it, a very uncertain development here. Give us a sense of what you think it might mean for General Motors. You just mentioned semiconductors more broadly.
The mandatory mask policy at all of our sites because we know when people wear masks and follow the appropriate social distancing and the sanitizing recommendations, people can be safe at work. And so I think we're in a very different position than we were over a year ago when really we weren't sure. We know the protocols work, so we're going to be applying those. And again, as we all leverage all the
So, Mary, we're talking about some headwinds that you've been facing. What about some possible tailwinds, particularly with respect to pricing? Because there's something of a shortage of vehicles for all sorts of reasons. Prices seem to be pretty robust. How much is that lifting your profitability?
Well, clearly the strong pricing environment and the strong demand is something that is really supporting our strong earnings. But I would also say when you look at General Motors specifically, we've given our dealers tools that they can see what's coming. There's many times a truck arrives at a dealer and most of the vehicles on the truck are already sold. We're also helping them order the most popular or the best configured vehicles for their era using data analytics. That's allowing us to move vehicles faster. So, I think because of our portfolio, even though there'll come a point when we have more availability that they'll see some moderation in price, I still think we have a strong pricing opportunity. And of course, we're going to be more efficient with all the lessons we've learned in this last 6 months.
And finally, Mara, I mentioned the substantial investment General Motors is making in electric vehicles. What visibility do you have into the demand for those vehicles? I know you're going to start taking some orders for the Lyriq in September, but do you know that there will be the demand there? I know you're going to have the supply.
Well, we do a lot of customer research, and customers are telling us if it's a beautifully styled vehicle with about 300 miles of range, it's affordable, and then there's a robust charging infrastructure, they're very interested in owning an electric vehicle. So that's why we're working on the ecosystem to make sure as customers buy an electric vehicle, it's a outstanding customer experience. And that's, I think, what we're going to need to do to drive EV adoption, but I'm confident that we will. And then when I look at our products that are coming out, the vehicles, we haven't shared many of them, but when you look at the strong demand for the Hummer EV and the strong interest in the Lyriq that will begin to take orders next month, I feel very confident that we're going to see strong EV adoption.
Okay, Mary, thank you so much for your time on a very busy day for you. That's Mary Barra. She's the chairman and president and CEO of General Motors. Tom?
David Weston, thank you so much. Greatly appreciated. Futures negative 16, and Lisa Bramos, we see a deterioration in the yield space here, really beginning to test a 112 handle.
And this comes on the heels of the ADP report that was disappointing, but it also comes as we get some headlines, including that Hong Kong is suspending the quarantine exemption for China travelers, basically making it even more difficult to travel internationally or even domestically. And this sort of adds to the angst in China as lockdowns start to begin again in response to the Delta variant, Tom.
And it gives to the idea of a global sense of this. It's not just about the domestic politics of any state, of Germany, of the United States. It's the global feel of a really struggling Latin America, South America, and Asia.
And if you take a look at intraday, the price action in some specific stocks, I'm looking at American Airlines and Delta, and I'm talking about Delta, the airline. The concern here is really prevalent. The idea in American Airlines is down about 2%. I mean, how much can travel get back online if we continue with these outbreaks that are inconsistent around the globe?
On radio and TV, what we're going to promise you is to continue to look at these markets to the speech of the Vice Chairman of the Federal Reserve System. The declarative speech was important. It has become ever more important this morning. He will join Adam Posen and the team at the Peterson Institute. We look forward to hearing from the Vice Chairman. Also some economic data coming up as well. Futures again deteriorate, negative 17. Dow futures negative 153. Stay with us on Bloomberg Radio and Bloomberg Television.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
How are you navigating what seems to be a really tough situation better than almost anyone else?
We've worked hard on the supply chain. There's no question there's a lot of work to do in the supply chain for semiconductors. And we're happy that we were able to exceed our second quarter guidance as well as, guide up for the rest of the year.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
The ADP report shaking things up this morning. Live from New York City. Good morning, good morning. Your equity market a little bit softer. 30 minutes away from the opening bell. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue, delaying a return to normalcy.
Delta variant.
Delta variant.
The big scare on the Delta variant.
If you'd asked me what the biggest risks are here,
Fear of the virus.
number one is the variant.
Return to office has been probably a bit on the slow side.
A lot of businesses are reevaluating their travel. How much Delta will delay the full normalization to activity.
From a macro standpoint, may slow demand, slow the economy down. The issue of the Delta spread.
When we think about the Delta variant, what could this ultimately become?
The Delta variant represents a delay in the restart narrative rather than a derailment.
Joining us now is TD's Priya Misra, JP Morgan's David Leibovitz, and Emily Rowland of John Hancock. We start this morning with an ADP report, a downside surprise at 3:30, looking for 690. Priya, here's the question. Do we have to wait a little bit longer for this supply-side response to see those kind of jobs gains we've all been waiting for?
I think we have to. I mean, we knew reopening was going to be not a one-off, unlike the shutdown. The reopening was going to be messy. There's frictions. We also have this issue where people are not re-entering the labor force. We are actually waiting for the September-October report. I wonder if the Delta variant actually means this is more October-November. So I do think that there's a risk that it gets delayed as the reopening, slows down a little bit and then sort of restarts. You talk about supply chain. I think that's the key part, the supply side of the labor market. When do people re-enter the labor force? And that will give the Fed a signal that there's still slack in the labor market, that they can afford to exit slowly. I think that's what the market's waiting for. I'm not sure we're going to get that in Friday's report. We are looking for a good report, but that supply side one, I think you'll have to wait a few more months.
875, the estimate into Friday. Emily Rowland, that is the issue. Priya's outlined it for us. Demand's not a problem. It's pretty robust. We're waiting for these supply issues to heal. Will we have to wait longer?
We might. The jobs market in the U.S. still has a long way to heal. There are 7 million Americans who had jobs, before the COVID crisis hit, who still don't have them today. And now with the emergence of the COVID variant, we may get another element here that delays the ability of people to return to work, whether it's women who are hugely sidelined, may need to stay home with kids again. I'm really hoping hard that doesn't happen for me personally, but that could be a huge issue as the labor market continues a slow process of healing. And as it relates to the Fed, what it means is that, our view had been the Fed's not going anywhere. And we continue to see that timeline potentially be pushed out here as the reopening slows down. So what it means for investors, you don't want to be at the short end of the curve. You want to reach into the intermediate part of the curve to generate some yield. Looking at double Bs, looking at triple B corporate bonds is really the sweet spot now. Every little bit counts in fixed income. outcome, and that's really where you need to be.
We'll come back to those market calls in a moment. David Leibovitz, to bring you in. When I asked that question, how much longer do we need to wait? The answer is longer. Is your answer longer as well?
You know, I think that it is important to recognize that economies do not move in straight lines. And what we saw in 2020 in terms of the lockdown was a very unique development from both a policy perspective and an economic perspective. And so, you know, I would agree with Emily here. I think you need to pay attention to what happens with schools over the next couple of weeks. I think that is going to be very telling as to what we should expect from the labor market into the end of the year. And again, you know, you're seeing Delta cause some concerns. You're seeing people sit on the sidelines and wait to come back into the labor market. I think that there is generally some caution in the economy today. And actually, that's very consistent with what we've seen coming out of pandemics historically. There's been some work done that suggests pandemics result in labor scarcity, they result in income flowing to labor rather than capital, and they result in a little bit more cautionary behavior on the part of the consumer. And so despite the speed with which things moved in 2020, I think we need to be a little bit more patient here in the end of 2021 and into the beginning of 2022.
Seeing that cautionary behavior from corporations as well, I want to bring in Kaylee Lyons for more on that. Hey, Kaylee.
Well, John, it was already complicated for these companies to navigate the pandemic and navigate the return to office especially, and it has gotten just more complicated because of the Delta variant. We've seen companies pushing back their return to office dates, Apple until October, Lyft out until 2022, but a growing list of companies are also now requiring that at whatever point employees come back to the office, they will have to provide proof of vaccination. That's the case now for Microsoft as well as for Google, Facebook, Tyson Foods, Uber, and others. And of course, there already are employees going back to office across the country, John, but the rate at which they are doing so does vary depending on location. The average in the U.S., according to the Castle Back to Work Barometer, sits around 34% in terms of the office occupancy rate. It's much higher in Texas, both in Dallas and in Austin. But here in New York City, where you and I are, the rate is well below both of those cities and that national average. And you'll notice on the right side of that chart there, that return to office climb is stalling out in recent weeks. That's obviously as the case count has risen due to the Delta variant. And a big reason why that case count has risen, John, is because also stalling out is the vaccination effort here in the U.S. The U.S. now only giving about 680,000 shots per day, John.
Kaylee Lyons, thank you. Kaylee, running through the debate, the issues right now. Let's talk about what it means for this market. Push you through the bond market. This is what Invesco's Brian Levitt had to say. Take a listen.
Lower rates we've got to take seriously. It's a bond market that is expecting growth to moderate. It's expecting inflation not to be a significant issue. And so, yeah, we've got negative real yields pretty substantial today, given the low nominal yields and given the inflation rates. I would expect rates to come back up some as we hopefully move through the Delta variant and have another wave of economic activity. But I don't think rates are going to, meaningfully higher from here.
I don't think we can go meaningfully higher from here. Priya Misra, on the bond market, do you think we can?
So it depends how you define meaningfully and when. It's a very negative carry trade to be short treasuries right now. I don't see a near-term catalyst because we just talked about how long it's going to take for us to see that supply side coming back. We are looking for 175 on the 10-year by year end, but I see that as the last few months of the year as the market prices in the fact that, hopefully Delta peaks and comes back down, that we don't see the economy or the recovery being derailed. We expect another fiscal package to go through in the tune of, 3-4 trillion. And we expect the Fed to start tapering. And as that happens, I think the bond market is pricing in a reaction function of the Fed, a confused reaction function from the Fed. And if the Fed can clarify that, I think some inflation expectations, risk premium can rise. It's that terminal rate that I struggle with, that the market's only pricing in the end point of the hiking cycle at 1.2%. I mean, that's a really depressed view of the longer-term productive outlook for the economy. I think that can reprice higher. And therefore, it's like a 5 to 20-year, 30-year. That's the part of the curve that actually starts to sell off, but much closer to year end as some of these uncertainties around the virus, as well as the Fed reaction function, as we sort of clarify that, I do see rates rising, but I'm sort of staying clear from being short duration just right now.
For now, at least, 170 to 175, a look forward from TD. Emily Rowland, 160 at Morgan Stanley. I heard 2% this morning from Citigroup. Can you make a prediction, a forecast at this point?
We're actually looking at sub 1% towards the end of the year. We think that the 10-year Treasury may have peaked for the cycle here at 174 coming into the second quarter. If you look historically back over the last 40 years, 10-year Treasury yields typically peak right after a recession. So that's when you're seeing max fiscal stimulus. That's where you're seeing max accommodative Fed policy. And that's when the market starts to price in the Fed raising rates. For the last couple of cycles, the Fed has not done that as fast as the market has anticipated. Actually, you also look at other examples of tapering. Typically, when the Fed starts to taper, you actually see the yield on the 10-year Treasury rolling over. That's when investors actually want to embrace owning treasuries, as that appetite for owning risk starts to fade. So we actually see 10-year treasuries moving lower from here. The infrastructure package may cause some upward movement, maybe a little bit of a backup in yields here. We don't want to be too overweight duration here because of that, because of this improving economic cycle, but we see lower here as we head into 2022.
Well, there's a call. Your equity market right now, about 22 minutes out from the opening bell, just to get you up to speed, down 15, off by a third of 1% on the S&P. The Russell down 20, negative 0.9%. The NASDAQ off by about a tenth of 1%. David Leibovitz, how about that? We've seen a peak on a 10-year yield, according to Emily Rowland and the team. A peak already for this cycle.
So I'm not sure we've seen the 10-year peak for this cycle. I do think what we've seen, though, are a view amongst the investment community that we have seen peak economic growth. And I frankly think what needs to happen here going forward is a recalibration of expectations. And, people need to get comfortable with the fact that this surge everybody was predicting was going to materialize in the United States is going to be a little bit softer, but arguably that extends the duration of above trend growth into 2022. And in terms of what catalyzes yields higher, and I would agree with the idea that we finished 2021 closer to 2% as opposed to closer to 1%, I think it's the global growth story. I think what you need to see is further progress on vaccination in the rest of the world, the beginnings of that synchronized global growth environment, much like we saw back in 2017. And effectively, if the U.S. can pass the baton to EM and the rest of the world, to me, that gets yields moving higher into the end of this year.
And can China get in the game as well? So let's go to China right now. We've seen more restrictions come in. More than 40 cities in China at the moment restricting travel. Beijing, the latest to restrict travel on the subway, perhaps. That begins on Thursday. This from Nomura, downgrading their economic projections, lowering its GDP forecast for the full year to 8.2 from 8.9. Still lofty, but it's the direction of travel that matters here. Let's bring in Bloomberg's Katie Greifeld for more. Hey, Katie.
Hey, John. Well, let's talk about that bond rally and why it's so fierce. So you saw real yields hit another record low today of minus 121 basis points. And because of that, you saw Citi downgrade its outlook for U.S. stocks from overweight to neutral. And the thinking there is, should we see an economic recovery that really boosts rates in a big way? That's going to drag on U.S. stocks, which again are very heavily weighted to tech. So instead, Citi's going to Japan. Analysts there upgraded their forecast for Japanese equity markets to overweight, citing cheap valuations and the fact that Japan's equity market is more heavily weighted to cyclicals, the type of sectors that should benefit from higher rates. But John, as you know, real rates, they're low for a reason. You have Delta concerns building, and the global growth outlook is darkening. And as a result, Nomura is cutting its forecast for Chinese GDP. Their full year forecast is now 8.2% versus 8.9% previously, thanks to a wave of new restrictions on travel and tourism, John.
Katie, thank you. Thank you very much. Let's talk about what it means for this bond market. 10-year nominal yield in America, 10-year real yield in America. This is the situation right now. 112.60 was the low from a couple of Tuesdays ago. Right now, 113.57. Real yields are at record lows, negative 121.25. Priya Misra, this is a market which the Federal Reserve owns a third of. And I'm trying to work out if there's any signal here whatsoever. Is there for you?
I think real rates really here is a signal that nominal rates are where they are. Because I almost think of real rates now as a bit of a residual. You have nominal rates, the 10-year trading at 115 or lower. You've got inflation that's coming in high, and that's preventing those break-evens from really doing much of that move lower in rates. And therefore, all of that heavy lifting has to be done by real rates. I don't think it's giving you much of a policy signal per se. It is telling you that there's a significant amount of accommodation in the system. That doesn't jive with the Fed. That's clearly talking about tapering. They're debating timing, pace, composition. And the U.S. Treasury that didn't cut auction sizes, we didn't expect them to cut auction sizes today, but they are talking about cutting auction sizes. But you put the two together, and there's still a significant amount of supply that has to be taken down, with the biggest buyers stepping away. So I do think real rates will have to, at some point, confound the fact that there's a lot of supply and the Fed is stepping away. We need to find the marginal buyers that are going to look for higher real rates. So that's why I do think real rates will need to rise, but we do need some of the economic concerns. And I have to say the Fed needs to clarify how much of an overshoot they're actually comfortable with.
Well, that's over to Vice Chair Clarida in about 47 minutes. Emily Rowland, I want your thoughts on this. I know you think we might have seen the peak in yields for this cycle, but do you think there might be some asymmetric risk now around real yields at negative 121?
Yeah, look, I mean, we just figured out how to generate inflation globally. You shut down a global economy, you reopen it, and then you spend, $10 trillion across fiscal stimulus and doubling the size of the Fed's balance sheet. In our view, we're just not going to be doing that again. That was a warlike response to the virus. It was, hate to use the word unprecedented, but we just don't expect those inflationary pressures to build the way in which a lot of investors expect. So I think that has big implications in terms of treasury yields. And again, I think that means you want to stay away from being at the short end of the curve. You want to reach into the intermediate part of the curve at this time.
David, this is the tough part, isn't it? You look at real yields down here at 121.39. What does that mean for you, for the equity market at the moment?
So I think that, this is a clear reflection of coordinated quantitative easing, which is something we did not see in the aftermath of the financial crisis. We never saw the ECB, the Fed, the Bank of Japan, the Bank of England all buying in unison. And I do think that is distorting the signal that is being sent from the bond market. And, you asked about the equity market. I think it's interesting to look at some of the price actions so far this week. You saw the more cyclical parts of the equity market begin to perform a bit better. I mean, one would have expected, given the price action yesterday, particularly in treasuries for growth to outperform value. And effectively, we saw the opposite. And I acknowledge that equity markets can be more optimistic than the bond market from time to time. But I think you're getting a growth signal, not only from the price action in stocks, but from the earnings that have been coming through as well, which signal that growth is set to remain above trend. And in my view, rates are too low if that's the outturn we end up seeing. I would also, bringing it back to where we started the conversation around the labor market, I mean, the tough thing for me to square the circle on is how wages fit into all of this, because you are seeing upward pressure on wages to an extent that really hasn't been observed since the early 1980s. Yeah. And I think that keeps inflation more persistent. I don't think it gets the Fed moving faster, but I think it does mean that long rates are too low at current levels.
David Leibovitz sticking with us alongside Emily Rowland and Priya Misra. Your equity market taking a dip lower, off by a third of 1% on the S&P. Looking at the movers ahead of the opening bell. Here's Abby.
John, well, we do have some breaking news just out moments ago. Novavax shares popping sharply higher, up more than 10%. This on the news that the EU has signed a contract with Novavax for up to 200 million vaccine doses. So you can see shares really being rewarded by that news. As for one stock that's moving in the opposite direction here on the open, or on the before the open, is GM, down 4.1%, a mixed quarter. They beat revenues by 8%, but adjusted earnings missing the mark, hit by the supply chain chip issue. However, they lifted the view for the year. The stock is down, though, probably because it was up 120% on the year. And then the reflation trade, John, what reflation trade? JP Morgan, Bank of America down with yields on that massive ADP report miss, and Chevron and Occidental down in line with oil back below $70 per barrel as everybody's focused on the idea that growth is slowing.
Abby, thank you. Banks looking softer. Coming up, interpreting the Fed speak, Vice Chairman Rich Clarida moving into the spotlight with division building at the Federal Reserve. That conversation up next from New York. This is Bloomberg.
Assess the sector as a whole? Is it making a better case for itself at the right price at this point?
Most of the big hedge funds, most of the people that have been growing, have been delivering very good performance. We have, but so is a number of the peers. It is definitely the hedge fund business is getting more about the large getting larger and generating more performance, being able to hire the best people, thereby generating better performance, thereby getting larger. So when you look at the performance of the largest, say, 20 or 50 hedge funds, the performance has been pretty good over a number of years, and the inflows have been pretty good. You know, this is another quarter of positive inflows for us. I think one of the bits you're seeing at the moment is every client is worried about inflation. When they say they're worried about inflation, what they really mean is, I own a load of bonds, is that going to cause me a problem?
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
My guess is we don't get a tightening until after the next presidential election. If you look at the last two cycles, the average time from the last rate cut to the first rate hike was 7 years. So this isn't really that unusual.
They're coming around. With each successive meeting, he started to talk a little bit more, acknowledging that labor demand is very strong. I think they get it. I still think it's next year. My first rate hike is June, so middle of the year.
What a debate at the Fed. In the past 24 hours, one call from the Natixis saying no hike through the next 3-4 years, and then another call from Amherst Pierpont basically saying June of next year. We now turn our attention to Fed Vice Chair Richard Clarida, top of the hour, 40 minutes time, delivering a speech on anything he would like to talk about. Let's bring in Bloomberg's Michael McKee for more. Hey, Mike.
Hey, John. Well, he is going to talk about the monetary policy outlook. At least that's the title of his speech. So we will get an impression of what is going on. Of course, over the last couple of days, we've had the Taper Sooner caucus, the people who are on the side of Steve Stanley there, calling for the Fed to acknowledge that the inflation rate is running faster than it should be, and the Fed should start cutting back on QE. We haven't heard from Clarida in quite a while, however. It was May when he said, I think it's going to depend on the flow of data we get. Well, boy, that's a big help. Hopefully he'll be more specific today because, of course, he's one of the top three, the leadership of the Fed. And Jay Powell last week said, we're not there yet. We're not ready. They need more data. John Williams has been on the dovish side as well. So if Clarida comes in that way, then the markets may readjust. And certainly on the back of that ADP news this morning, there is a question about whether, Joe Livornia or Steve Stanley is going to be correct. Their views. And this graph shows the discrepancy. We are still, the blue line, jobs way short of where we were before the pandemic, about 7-8 million jobs. That argues that the Fed should wait for a while. But you look at inflation way above what the Fed wants. That argues that maybe tapering should be sooner. So we need a tiebreaker. Rich, Clarida, it's you.
It's over to you, Vice Chair Clarida, in about 40 minutes' time, 39 minutes to be precise. Priya Miz, I want to come to you really quickly before we get to the opening bell. What's more important to this market, do you think? Where do we get the bigger reaction? Big upside surprise on Friday or big downside surprise?
I think downside surprise. I think the pain trade is still lower rates. A lot of people are still looking for higher rates. So if you get a downside surprise, I think we really start to question, is Delta having an impact? And that big assumption that it just delays, not derails, you start questioning that. And I think that would have a bigger reaction than, say, 1 million payrolls on Friday.
Emily, do you agree?
I do, and I think perhaps you get another bad news is good news surprise. All eyes are on the Fed. Markets want to see a continued dovish Fed, so risk assets can continue to rally, and I think that's exactly the scenario that you see.
Ugh, it's our least favorite thing. Is bad news good news this Friday, David Leibovitz, is it?
You guys took the words right out of my mouth. I think we're back in an environment where investors are scared of the Fed's shadow, and what they don't want to see is a Fed that's beginning to move to the exit in a way that they would deem to be too quick. And so I think a big miss on Friday would arguably be bullish for risk assets.
David, Emily, Priya, sticking with us through the opening bell. Coming up the morning calls and later, a lack of consensus on Wall Street. Citi downgrading U.S. equities. Barclays expecting stocks worldwide to climb the wall of worry. We'll get into that next. From New York, this is Bloomberg. Downside surprise on the ADP report, 330 was the number. We were looking for something in and around 690. After that downside surprise, we gap lower on the equity market, down by a third of 1% on the S&P 500. Coming into Wednesday at record highs, your small caps underperformed, down by 0.8%. The Nasdaq 100, some relative outperformance at a down market, down about 0.1% because the bond market is firm, yields are lower. What does that ADP report mean for payrolls Friday? If anything at all, we can debate that. Let's get you some morning calls. That's the price action. Here's a call from JP Morgan, upgrading Under Armour to overweight, $30 price target. The analyst highlighting a favorable risk reward following the stock's recent underperformance. We're positive there by 2.73% to 23.32 in the pre-market. Your next call from the team at Atlantic Equities, downgrading Clorox to neutral, 150 price target. The analyst expecting weakening demand and additional cost pressures to continue. Down there about 0.5% in early trading, 163.31 going into the cash open. And your third and final call from Bank of America, upgrading Simon Properties to a buy. The analyst seeing a number of positive catalysts stemming from the company's quarterly results. We're negative there, just 0.2%. Coming up, strategists taking their positions, Wall Street remaining divided over the path of equity markets. That conversation just around the corner from New York City this morning. Good morning, your opening bout is up next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
24 seconds away from the opening bout this Wednesday morning. Good morning to you all. In many ways, the week begins right now this morning. ADP behind us, Vice Chair Clarida in front of us, together with the ISM services read. Going into that, equity futures softer, lower, down by 13 on the S&P 500. We're off by about 1/3 of 1%. Clear underperformance from the small caps. Outperformance of the down market on the NASDAQ. We're basically unchanged on NASDAQ 100 futures. That's the opening bell. Switch up the board and get to the bond market. From stocks to bonds, Treasury yields down 3 or 4 basis points to 113.57. Took another look at a 112 handle earlier this morning off the back of that downside surprise on the ADP report. 112.60, the recent low from a couple of Tuesdays ago. In the FX market, euro dollar just south of 119 now. Dollar weakness, yields lower in the mix. Those two correlate. Euro dollar back to 118.97. We're positive there, almost 1/3 of 1%. And crude gapping lower. South of 70, 68.50 on WTI. We're down by almost 3 full percentage points. That's the cross-asset story this Wednesday at the market desk with your movers. Here's Abby.
John, stock softer, as you were just mentioning here on the open. A piece of it, shares of CVS, down sharply, down more than 4%. This after the company management flagged inflation in the form of higher costs. Plus, they're saying it's likely that they'll be giving fewer COVID vaccines as the year progresses. So despite the fact that they beat their fiscal third quarter estimates, investors focused on the outlook and the fact that COVID appears to be slowing the picture there. Turning to the travel trade, it is slowing down too. Hyatt missed in a big way, top and bottom line estimates, bottom line adjusted estimates, I should say. RevPAR, a measure of revenue per room, at the highest since 2020, but folks don't care. Plus, United Airlines, American Airlines, Carnival, fears that this resurgence of COVID and the Delta variation, John, really crimping into the reopening trade and the reflation trade, because on the bottom of the pile, as you know, energy, financials, and materials.
Abby, thank you. In the early part of the session, 90 seconds in on the S&P 500, we declined by 1/3 of 1%. Leading the losses, Abby alluded to it, energy down by 1.82%, top of the pile just about. Relative outperformance, information technology positive. The only industry group on my screen right now in positive territory, up by 0.05%. Real estate in the mix, up by 0.02%. I make that 2. Elsewhere, Citigroup coming out with a call this morning, looking for bond yields to go back to 2% and downgrading U.S. equities. They say the following: the U.S. equity market is more vulnerable to higher real yields because it has a heavy growth stock weighting. Hence, we cut the tech-heavy U.S. to neutral. With more, here's Bloomberg's Candy Lines.
Well, John, Citi may be turning more bearish here, but by and large, the bulls seem to be winning in that, yes, we are a little bit softer at the opening bell today, but we are falling from another all-time high. And our colleague Vidal Naharik did the math and found that this market is hitting a new all-time high every 4 days, John. And we haven't seen a major pullback since November, 9 months since this index has fallen more than 5% from its peak. And yet the bulls just keep on getting more bullish. Bank of America has a sentiment indicator tracking how bullish the optimism of strategists. And it is now at its highest level since its pre-crisis high, which the bank says is getting close to triggering a contrarian sell signal, a point where extreme bullishness is actually bearish for stocks. But of course, the bulls will just say, hey, if you need a reason to buy, check out earnings. Because yes, in the second quarter, the growth has been stellar. The average company in the S&P 500 seeing earnings up 98%. That's 186% for the mid caps, 290% for the Russell 2000 small caps. And yeah, Europe is doing pretty well as well. But again, John, it is this idea of the peak, that it's going to be downhill from here. And speaking of lower from here, I would just note that the average year-end strategist target for the S&P 500 is 4278, more than 100 points below where we trade today. And the gap between the lowest, 3800, and the highest, John, 4700, quite wide.
Kelly, thank you. We mentioned Citi. Tobias Lefkovich looking for 4,000, so well south of where we are right now. This lean into the UK of Citi, led by the team by Robert Buckland. Citi looking at the UK, looking at Japan, that overweight off the back of what may or may not happen in the Treasury market. This is the view from Barclays, expecting strong liquidity earnings and a solid economic backdrop to support global equities amid rising headwinds. They say the following: investors have dry powder to keep buying dips. Strong earnings will help alleviate macro worries, and global growth should be solid in the second half. We expect equities to continue climbing a wall of worry. Let's get this view from Priya Misra, David Leibovitz, and Emily Rowland. And Emily, I want to start with you on the equity market. I know you're cool for the bond market, but let's war game this out. If we had the 70 basis point real yield shakeout the Citi are looking for, 70 basis points higher in reals, and nominals going back towards 2%, what would that mean for the equity market from your perspective?
John, look, I feel like I've been the bear of the trio today, and I want to set the record straight. We do believe that equity markets can continue to climb higher here, even in the face of lower real yields. The earnings engine is on. And when you look at next 12-month earnings growth in the U.S., it continues to climb. This is one of the reasons why the U.S. equity market, in our view, is the best place to be globally. And we have these, cyclical stocks that should benefit as this economic cycle continues to unfold. It's the best across the globe here in the U.S., looking at things like PMIs, leading indicators. U.S. economic growth is the best. We also have an earnings engine that's superior to the rest of the world. I heard you say the other day, you can tell a lot about a person of whether or not they like growth versus value. And I thought to myself, why does it have to be that way, John? And I'm here to say that I think you can benefit by owning part of that value trade. We, in particular, like industrials, we like healthcare. Those are areas that have pricing power as we move forward. But we actually want to pair that with growth, and in particular, quality growth, to be able to defend those margins and to be able to have that pricing power as we move forward into a more challenging environment.
I think, Emily, it says more about me that's the question I use to find out a lot about other people. David Leibovitz, the relationship between the bond market and the equity market. If we had that real yield shakeout of 70 basis points higher, what would it mean for your call?
So, we've been of the view that it continues to make sense for investors to embrace cyclicality. And I would agree with Emily, we're very much of the view that you want to own growth and rent value here. To me, by my lights at least, the way that higher rates impact the stock market is vis-a-vis valuations. And so we're just in the business of following the earnings. On the growth side, that's looking for quality streams of profits that we think we can get at a reasonable price. And on the value side, those stocks, those sectors, those industries continue to look cheap on a relative basis and comfortable taking a little bit more risk there, going into things like financials as well, where we think that the buyback and dividend story could provide a nice support to prices into the end of the year. And so, very much of the view that the places you want to avoid in the equity market are the story stocks, the names that are relying on elevated valuations. Against the backdrop of rising rates, you need something to cushion that downward pressure on multiples. And what will end up setting you free is earnings. So to us, it's really all about the cash flow.
David, just to put you on the spot, though, is that really tidy absolute performance from the sectors you described, the style you described, or is it relative outperformance in a broader down market off the back of higher real yields?
So I think what's so interesting, and we saw this at the beginning of the year, was as rates moved higher, and let's not forget in February and March, they moved higher at a very rapid clip, which certainly caused a degree of indigestion in the equity market. We frankly saw that the growthier parts, which obviously drive the headline index level, were able to stand their ground. And so I think you could very much see churn in those top names of the S&P. Maybe they don't necessarily move higher. Maybe the market just grinds higher. But I don't think that the market needs to roll over, as evidenced by what we saw earlier this year. Value can outperform while growth stands its ground, and that's not necessarily a bad environment. It's actually a very good environment for active managers in particular.
We had a great year in 2013, and nominal yields went for an absolute flyer, and equities were flying too. I want to repeat this line that came from Citi Priya and just get your view on it. Citi rate strategists expect 10-year Treasury yields, now 1.2%, we're south of that level at the moment, to rise towards 2% into 2022, and real yields forecast to rise 70. Priya, from your perspective, what would have to go right for 70 basis points of a move of real yields to develop?
Sure. So I think if it is a Fed reaction function driven rise in real rates, I think it's self-limiting. So for it to be a sustained move higher in real rates, it has to be the supply side. We started the program talking about the supply side really in the labor market, some of the supply chain disruptions going away, and really the market feeling better about longer term prospects for the US. I'm not sure we get that very quickly, but I do expect a rise in real rates. I would say the speed of the move is important. If it's a gradual rise, if it is a rise not just because the Fed is tapering come what may, but the economy actually allows the Fed to taper, that there is strength in the data, the supply side is starting to show itself, the labor force participation is rising, allowing the Fed to exit slowly. That sort of a real rate rise, I'm not sure is that negative for risk assets because, every asset class prices in the economic outlook and the reaction function. If this is about the economic outlook, we can have a, good risk asset move even with a rise in real rates. If this is a Fed reaction function, and I think that's what the market's been struggling with, if the Fed feels pressure from the inflation front and they decide to start tapering earlier than the economy can handle it, that's when I think I get really nervous about risk assets.
All roads seemingly still lead to the Fed's reaction function and policy of the Federal Reserve. Let's wrap things up on that. As I just see, according to Michael McKeon, I'm looking at the numbers now just to see, 870,000 is the median estimate for payrolls this coming Friday now. We've come all the way down from north of 900, 870. Moving target, estimates keep coming through. This is in our survey here at Bloomberg. 870,000 is now your median estimate for Friday. Before we get there, claims are Thursday morning. Before we get there, Vice Chair Clarida speaks in about 20 minutes' time. And guys, that's where I wanted to finish. Emily Rowland, what are you looking for from Vice Chair Clarida in 20 minutes' time?
You know, when we listen to Jay Powell, he's very resolute in terms of his conviction of letting this Fed's average inflation targeting framework play out. If we start to see a little bit of wavering around that, if we start to hear a little bit of less conviction on that, I think that's something that's going to have a big impact on markets.
David Leibovitz, your take?
You know, John, we talked about this the last time I was on, and I would agree with Emily. We can't see the Fed unravel here. They need to be unified in their view on the direction of monetary policy. And so what I'm looking for is really a reiteration of what Powell has been saying as of late, and a view that says, look, we care about the labor market. We think we have the tools to deal with inflation if it does start running hot. So we're very much going to measure twice and cut once when it comes to the implementation of policy going forward.
Really interesting take there. Priya Misra. Final word.
Sure. So I would agree. I think I do expect a reiteration of that framework, the FAIT policy. But I'm also looking for more of a framework. You know, Chair Powell talking about why inflation is transitory, maybe get more of an academic framework, which we tend to get from Vice Chair Clarida. So I'm looking for that framework of tapering. To put it in context, we're talking about tapering just in case. This can still happen much later. So setting the tapering discussion in context. But I also think he needs to walk a tightrope by saying that the economy and the economic outlook is still solid, because at least the rates market is beginning to question the economic outlook. And so we'll be also watching for Vice Chair Clarida's views on the outlook. Does he feel as confident about his forecast, you know, for the rest of the year and beyond, plus the reaction function?
That speech coming in 18 minutes' time. Priya Misra, Emily Rowland, David Leibovitz, thank you very much for joining us through the last 40 minutes or so. Love that line from David. Measure twice, cut once. Your equity market down by 1/3 of 1%, or maybe hike once or cut tapering. I don't know. We're down 1/3 of 1% on the S&P. We're negative 13 on the S&P 500. Let's get you some movers. Here's Abby.
John, the S&P 500 may be down slightly, but this is simply extraordinary. The Reddit traders are back at it. The shares of Robinhood absolutely surging, up 65% right now, up for a 4th day in a row. Over those last 4 days, up more than 90%. This could have something to do with folks thinking that there could be another lockdown. There will be more trading from home, but mainly the Reddit traders back at it again. There's Robinhood up an extraordinary 65%. However, on the other hand, the reflation trade not doing so well. The banks are down on that massive ADP miss. You have yields down as bonds rally. That's weighing on banks. Another haven play, interestingly, gold up more than 1%, so the miners are up. And the only one of two sectors up on the day, just slightly, tech, another form of haven. So it's that kind of a slightly risk-off day, John.
Abby, thank you. Thank you very much. Coming up on this program, we take things to China and a brewing downgrade emerging from the economics community. From New York City, this is Bloomberg.
I assume you have a lot of people saying the food isn't as healthy as they might want it to be. Is that the biggest challenge, or just growing the company?
Ray Kroc had a famous line, if you're not green and growing, you're red and rotten.
industry is entirely online, ostensibly because of the pandemic, but in large part, we're seeing a massive pivot to mostly live streams for video game coverage. We're going to be all online instead of in the convention center for the first time this year, and that promises to be a really different experience.
Industry has really been interesting during the pandemic. It has actually grown substantially since everyone was stuck inside. And of course, this makes sense, right? We're all looking for some amount of entertainment, and stuff like Fortnite in particular offer also a social component, right? People can join up and kind of meet up online and spend time with their friends. So in a lot of ways, this all makes sense.
Friday is Jobs Day.
For every positive thing you point to, there's something less positive.
The June report fell short of estimates.
The unemployment rate goes up to 5.9%. It's one of those things where you say it's good news. The unemployment rate goes up.
What should we expect to see from July's report?
A lot of reshuffling. We'll continue to see hiring at large pace.
Are people looking to return to the workforce?
Businesses have a lot of jobs to fill. They can't find workers.
The July jobs report, Friday on Bloomberg Television and Radio.
Risks to growth in China are skewed to the downside. We have had this call for a while, and now, of course, with the spread of the Delta variant and the potential for the lockdowns, the still low rate of vaccination means that I think China growth is going to slow down more than expected.
Really important developing story in China. It's COVID-19 outbreak prompting investors to revise the country's economic growth projections. Nomura lowering its third and fourth quarter growth forecast, with chief economist for China, Lu Ting, saying the following: the draconian measures taken by the government are resulting in potentially the most stringent travel bans and lockdowns in China since the spring of last year, necessitating a downward adjustment to our GDP growth forecast. With us for more on this is Damien Sassower of Bloomberg Intelligence. Damien, I think we've got to be laser focused on what's about to happen here.
Well, absolutely. I mean, look, the fact of the matter is, for an economy that's going from export-led to consumption-led, the Delta variant now, 32 provinces within China, 50 cities putting travel advisories for residents not to travel. This is not good for consumption. This is not good for GDP growth, specifically in the third quarter. In addition to Nomura, we had some growth warnings from NatWest, from Goldman Sachs of late. So, this is serious stuff. But I think, for me, the focus is on Beidai-Hoshu and the lack of information we're seeing out of Hubei province. I mean, this is the annual summer conclave that basically, President Xi and all the party leaders and elders should be attending, and we're seeing nothing, and Xi may not even attend. And for me, a second year in a row of nothing out of Beidai-Hoshu means that Xi is basically making decisions unilaterally and firmly has his finger on the grip of, policy appointments going forward, vice premiers and the like, and it's just going to be very interesting for me.
Distracted by 112.58 on 10s, Damien, forgive me, just briefly. 112.60 was the low on a 10-year yield from a couple of Tuesdays ago. We just broke through that. Just very briefly, 112.58, then snapped back to 113.40 on a US 10-year yield. Damien, there are some fears about growth right now, not just in China, but also in the United States to some degree. I think what's important for China is that they have a very different tolerance level to infections in that country, and it doesn't take much to end up doing a lot to restrict that economy. Can you walk me through that, the different approach here from a policy standpoint from the Chinese Communist Party compared to, say, what we're seeing elsewhere?
Well, what's interesting, Jonathan, I mean, the recent crackdown, everything, I mean, China's interbank financial system has really been unscathed by it all. I mean, they did the RRR cut, but really, the accompanying statement said that, China is really not, in an accommodative stance. They don't expect to be easing policy very aggressive, and most forecasts on the street are calling for another RRR cut before the end of the year. If you look at the one-year non-delivered deliverable interest rate swap rate in China, it's right on top of the 7-day repo rate, which means for me, a guy who likes to receive in the front end of China for so long, there's really not a lot of juice there. There's not a lot of carry, not a lot of roll down left. And how are they going to draw in foreign investment if they're not really yielding what they once did? I mean, that pickup over U.S. yields, as you rightly point out, is compressed.
Damien, you've talked about something over the last week that I think is really important, the stability we're seeing in China. I was looking at dollar China this morning. I think we're at 646, and the average year to date was 647. We've hardly done a thing. Yeah. Where are you seeing this show up in this market at the moment?
Well, it's really interesting because, you know, dollar yuan has really tracked that 10-year yield differential between China and the U.S. And the fact is, it's really not right now. It's really kind of in this phase where, you know, it's sort of consolidating, it sort of isn't, and it's really, you know, point of mind for me. But again, you're absolutely right. I mean, you have to look at growth if you want to get a sense of where China yields are going. And I mean, look, I hate to talk technicals, Jonathan, but if you look at Fibonacci retracement levels, 281 is the technical resistance level for China yields. We're at 283 now. There's not a lot of downside there left.
I'm happy to give you some space to talk technicals, Damien. We've just got to go now. Damien Sasser on an important story in China at the moment, a developing one, and one I don't think we've paid enough attention to relative to how important it is. Let's get you some sector price action with our stocks editor, Dave Wilson. Hey, Dave.
Hey, John. Yeah, 9 of the 11 main industry groups in the S&P 500 are lower at the moment. It's the more economically sensitive areas leading the way down, especially energy stocks, but you're also seeing financial and industrial companies lower as well. Only 2 higher, real estate and healthcare. And the healthcare gain is especially notable because 2 of the biggest companies in that index had disappointing results. Amgen late yesterday and CVS Health today. And this is a group that really has been showing strength for some time. Just yesterday, the S&P 500 healthcare index set a record. So the fact that it's even higher with these companies, I mean, Amgen, 2 of its biggest sellers, the rheumatoid arthritis drug Enbrel and the psoriasis treatment Otezla not really kind of performing up to speed. And CVS Health talking about how they now expect COVID to be sort of a modest negative, as they put it, for their second half results. And yet at the same time, you still got the group moving up. You know, that really does say something.
CVS raising that minimum wage to 15. I just wonder, I was talking to Tom about this earlier, does $15 an hour get it done? Considering the amount of demand we have for employment in this country and the lack of supply at the moment. Hey, Dave, thank you, sir. Thank you very much. Coming up, the market-moving events you need to be watching. That'll be next in our trading diary as we wait to hear from Vice Chair Richard Clarida in about 8 minutes' time. And there's some data in the mix as well. It's the ISM services read. Going into that, equities coming off all-time highs, record highs into Wednesday. We're down about 10, 11 points now. We're off by 0.25% on the S&P 500. And your 10-year yield breaking through the recent lows of 112.60 briefly at 112.58. Right now, we bounce back to 114.23. From New York City, this is Bloomberg. From New York City this Wednesday morning, good morning. About 25 minutes into the session, the day and in many ways the week started with, of all things, the ADP report at 330,000. We were looking for 690 in our survey. That was the median estimate. Off the back of that, equities just a touch lower, softer, down by a third of 1% on the S&P. Some clear underperformance by the small caps. The Russell down by 0.7%. The Nasdaq just about holding on. If we switch up the board and get to the bond market, this has been a story. Your US 10-year yield, recent lows 2 Tuesdays ago, 160. Breaking that briefly at 112.58. At the moment, back to 114. Treasuries bid firmer, yields lower by about 3 basis points as we wait for one man, Vice Chair Rich Clarida. That's the price action. Let's get to that trading diary and get you up to speed on what to look for through today and through the trading week. We will hear from the Fed Vice Chair Richard Clarida at the top of the hour. Michael McKee, Alex Steele, Guy Johnson will run you through some of the commentary. Some of the commentary from a man we have not heard from since May of this year. We need to hear from him a little bit later. Alongside that, we'll get the ISM services data, some more economic data after a big downside surprise a little bit earlier this morning. Then a rate decision tomorrow from the Bank of England. That Thursday, we'll also get initial jobless claims as well. Then more Fed speak from Governor Waller too, a man who made some headlines a little bit earlier this week. And finally, the main event is payrolls Friday. 870,000 is your estimate, 850 the previous read. It's a moving target, and that survey keeps coming a little bit lower as this week grows older. From New York City, for our audience worldwide, this was the countdown to the open. This is Bloomberg TV.
Can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
Had an exceptional Q2. It's time.
The narrative of the day is strong earnings.
Bloomberg has the numbers.
We have about $12 trillion worth of market cap right here.
Find out who's winning.
Tesla beating across the board.
And who's losing.
That's actually pretty rare for Amazon. They typically don't miss on that scale.
And the voices to give you the important news.
Samsung reported another stellar quarter of earnings.
We are very clearly looking with confidence about what's next.
Bloomberg Television, your home for earnings season.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale